1.7, 1.8% this morning. It's had a massive run up again year to date of about 40%. We've been trimming those gains over the last few days. And Mandeep, as Lisa pointed out, maybe some nervousness around this name now because we keep raising the bar and they keep beating by double digits and then raising again. Mandeep, what is a beat for NVIDIA today? Because a beat for NVIDIA is very different to a beat for everybody else.
Yeah, look, I think we've gone from skepticism around what's the kind of the revenue run rate and margins, how long can they hold that, to really nothing could go wrong for NVIDIA, even though there are a lot of issues, you know, when it comes to the China exposure and hyperscalers developing their own chips. And anytime you see headlines like NVIDIA surpassing Alphabet or Amazon in market cap, you have to ask yourself, you know, what is the fundamental business that NVIDIA is in versus all these other giants, which have, if you look at the sum of the parts valuation, they've got multiple businesses. So really expectations are getting ahead of themselves, and there will be a point where, you know, it will be hard to just manage expectations. And I think NVIDIA probably is at that point, but look, they could come out and beat by double digits again, because we know every incremental CapEx dollar right now is going towards buying the chips, because there is literally a shortage of what they're making.
We'll get to China in 1 second, but Mandeep, do we have a sense of what the saturation point is for demand for all of these chips at this point, at the development that they're at?
I mean, you go back in time, you know, with chips, typically there is a digestion phase. And right now, the customer base is incredibly concentrated for these chips. It's your hyperscalers, your Microsoft, Google, Amazon. These are the biggest customers of NVIDIA's chips. And they're buying because of their cloud business. But at some point, it has to translate into revenue numbers for these companies. And right now, we know Microsoft is the only one that has quantified the revenue impact. The others are still developing that capacity because they can afford to keep buying it. But that I think the margin impact is crucial, because if NVIDIA's margins have grown 10%, it's coming at the expense of some other player. It's either the software players or like further application layer. And that is where you have to ask yourself, how long can they sustain that margins and at whose expense it's coming?
And then how many places can they be selling these chips? You mentioned China. What exactly are people looking for and skeptical about with respect to NVIDIA's sales in that country?
I mean, they have a 20% revenue exposure. And right now, the way they're trying to sustain that business, they're not trying to grow that business. I think their main thing is at least it should not be a hole in their growth numbers. And they're just coming up with a lower spec chip to make sure they comply with those regulations. But literally the focus on, you know, them sustaining that 50% growth is on other regions outside of China. And remember, their customer base is concentrated. So it's really 8 or 10 companies that's doing the bulk of the buying. I mean, if the governments start to buy them, that would be huge. And that is where, you know, the positive catalyst would come from. But right now, I think the customer base is incredibly concentrated for NVIDIA.
Well, Mandeep, to maintain that presence in China, they're going to be coming out with a new China card and chip that basically usurps these U.S. export controls. But how long will that last, given the fact that there's growing competition in China for the higher-end chip processors?
Yeah, no, that's a great point. And look, I think with China, you know, they're buying those EUV machines, they're setting up fabs. They really want to compete, you know, at the manufacturing level in terms of manufacturing these accelerators and custom chips. So clearly, you know, if you start looking out 2 to 5 years, it's a hard case to make that, you know, NVIDIA will still have the pricing power in chips where everyone is trying to develop you know, a better chip or same spec chip that NVIDIA has. But right now, they still have the chips that no one else can make, and that's why you see that in their pricing power.
Mandeep, I just get the feeling you think this might be a Sound the News event a little bit later on this afternoon.
I mean, anytime you see a multiple expansion like that, and as I mentioned, you know, Alphabet generates $70 to $80 billion in free cash flow. NVIDIA's revenue currently is $60 billion. Yes, it is expected to grow to $100 billion for data center, but you have to ask yourself, there is a company that's generating $80 billion in free cash flow that's trading at a lower market cap. And I think that's where investors will start to think, how long can they sustain these kind of margins and growth? And it will be hard to grow off a larger base.
Phenomenal
than it was,
run.
3-4 quarters back.
Just phenomenal over the last 12 months. Mandeep, thank you, sir. Looking forward to your coverage for the next day or so. Mandeep Singh there of Bloomberg Intelligence. Their stock is negative again in the pre-market. Just 3 days of losses, just building up over the last 3 days. Down again this morning on NVIDIA, going into the earnings a little bit later on this afternoon. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. is said to have told allies that Russia could deploy a nuclear weapon or a mock warhead into space as early as this year. Sources say Moscow is developing space-based capabilities to knock out satellites. A nuclear warhead in orbit would violate the 1967 Outer Space Treaty, to which Russia is a signatory. Russia says it has no plans to deploy nuclear weapons in space. Amazon shares up in the pre-market. It will be added to the Dow next week and will replace Walgreens Boots Alliance. Meanwhile, in the Dow Jones Transportation Average, Uber will be replacing JetBlue. Citigroup boosting CEO Jane Fraser's pay by 6%. That will make it $26 million. She's initiated what's billed as the largest rework of Citi in decades. The aim of that reorg, propel the firm from banking underdog to serious competitor. That's your Bloomberg Brief, John.
Danny, thank you. TK just wrote in. Really well. He's woken up. He's coming to the office. Got into the office about 15 minutes ago. Thank you, Tom. Says this, massive Dow analysis today. It is insane.
Well,
massive Dow analysis.
We knew this was going to happen. Well, we've analyzed it. Now we're done.
Boomer Radio kicking off in about 16 minutes' time with TK on massive Dow analysis. Looking ahead to that. Up next on this program, making the case for the Fed's first cut.
I thought we'd have 3 cuts this year, May, June, July, 25, 50, 25. I'm probably going to dial back on that. But part of my thesis was the Fed is not going to want to cut in September or November because it will look like an election manipulation issue.
That's coming up next on the program, live from New York City. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
TK's sending me so much hate mail already. Equity futures right now on the S&P, negative 5.2%. Yields are lower by about a basis point, 426.16. Under surveillance this morning, making the case for the Fed's first cut.
I thought we'd have 3 cuts this year, May, June, July, 25, 50, 25. I'm probably going to dial back on that. But part of my thesis was the Fed is not going to want to cut in September or November because it will look like an election manipulation issue. So I think they're going to have to be very cautious about what they do in and around the election so they're not in any way portrayed as affecting the election outcome. So if you take September and November off the table, yeah, maybe you only get 1 or 2 cuts and that's it.
Here's the latest this morning. As hot inflation reads push back expectations for the first rate cut, former Fed economist Claudia Sahm thinks they should be cutting rates already, writing this in the Financial Times. The longer rates stay high, the more the Fed risks seriously damaging the economy. Now is not the time for the central bank to drag its feet on rate cuts. It's the time for the Fed to get out of the way. Claudia Sahm joins us now for more. Claudia, let's get straight into it. This was a brilliant piece and slightly controversial given the prints we had on CPI and PPI last week. So let's go from there. Why do you think they're at risk of doing real damage to this economy, given the strength we saw in 2023?
The best way for the Fed to proceed is gradually, right? It's much worse for them to get into a crisis and have to cut 200 basis points all in one day. My argument is disinflation is here. We made massive progress this year, regardless of what happened in 1 week. When we looked at January, 2023 was a big step forward, and the Fed is well into restrictive territory, 25 basis points every other meeting. Just do something gradual because they really are pushing. They do not necessarily have the luxury of time, given the strength of the economy. It may not stay.
What gives you confidence that we can just shrug off the CPI and PPI prints we got last week?
So I shrug nothing off, and the Fed doesn't either. Yet there were a lot of anomalies in this data and a lot of signal, right? Like it was a bad week. Legitimately, it was a bad week. Chair Powell in 60 Minutes told us they want more data. The data need to be good, not better, and not as good necessarily. Now, you're going to have to squint it last week and say it's, good, but not as good. And yet there are a lot of January effects. There were a lot of anomalies in that data. We need to see more. And yet we should not overreact to 1 month of data. Markets, in my opinion, really did. And I don't think the Fed did. They look through a lot of the noise.
Did the market overreact? This actually is an interesting point, given the fact that bonds really did sell off and you did see yields go higher, but stocks held in there. And if you look at stock analysts, they're saying the reason why we're seeing such strength is because consumers keep spending, companies' earnings are going up. If you look at the on-the-ground analysis, it kind of backs the strength that looked like it might have been underpinning some of those numbers. Why do you think that's not an accurate reflection of true strength that can sustain regardless of when the Fed cuts rates?
So the Fed is going to primarily look at how it's working through the interest rates and when the cut's happening. What I point to last week is the Fed has gone all in on data driven to the point that every time we have a data release, you see market movements, at least in the bond side of the markets. And we saw, the probabilities move out for a cut on Monday. Then they came back on Thursday when we got retail sales, and they went back out on the personal producer index. I mean, we should not have those kind of gyrations. And I saw Mary Daly speak on Friday after the PPI came out, and she's like, my, thoughts about a rate cut haven't changed this week. Right, so the Fed is steady as she goes in many ways, and it's creating, I think, a lot of volatility. And like you said, there's disagreements between bond markets and stock markets. The last thing we need right now is confusion in financial markets. We got to get this thing on home, and it's just the data are going to be noisy, and the Fed has not given a lot of guidance on how they look at data. Right, they've just made it they put too much on the markets to interpret.
That's such a good point, Claudia. That's the communication of the Federal Reserve. Let's talk about the communication coming out of the White House. We've talked about it on this program so many times. We've talked about it together. Sometimes I'm just shocked that when you get really, really strong numbers coming from the economy, it's like tumbleweed at the White House. It's a struggle to get access to someone to talk about how decent sometimes these numbers are. You've written this morning in Bloomberg Opinion that Bidenomics is an easy sell if presented broadly. Claudia, can you give us a better idea of how you think this White House should be presenting some of their achievements?
I know it will be a shock to everyone, but I am a big fan of straight talk, right? And you have to go all in on your accomplishments and not pussyfoot around them. One important point that I made in the piece is, where is Biden talking about his win on gas prices? Right? They did so much to get gas prices down after Russia invaded Ukraine. They made so much progress to undo OPEC really pulling back, slow walking the production increases. And then they also put a green energy policy together. Like, it's the whole package, short-term relief, long-term relief, and it is absolutely crickets from the White House. Like, you don't have a lot of wins on inflation, take the wins you got. So I really don't get it.
Well, the one big win on the latest inflation data was the fact that the gem was that energy prices were so subdued, and that was because of gasoline. When it talks about Biden and communications, you know, a lot of Americans, Claudia, don't even know what the Inflation Reduction Act has in store. If Biden himself is not going to be able to sell it, who should be selling that to the American people?
Biden has to sell it. I mean, at the end of the day, you can have all kinds of people like me out there jumping up and down saying, hey, that was great policy. And I do it because it is great policy, not because it's red or blue. And they have to go all in on this. I worked on a lot of Bloomberg opinion pieces last year where I wrote about different aspects of the rescue plan. Every time I sat down, I learned something. I'm an expert. I should not be learning from doing background reading. Like, it ought to be all out there. So it's too timid. I mean, you're going to upset people, and you're going to have people argue back that you're just making it all up, but you're not. So if you have facts on your side, you ought to get out there and fight with the facts.
And what about the fact of the large federal debt? We got latest projections from the CBO. It is not getting any better. Jay Powell says it's an urgent matter. Isn't this something that many point to Bidenomics as the cause of?
So we've been gnashing at the teeth for decades about the size of the federal debt and its unsustainable path, and nothing has changed, right? We know the economics behind this in terms of programs, particularly entitlements, Social Security, Medicare, that could be changed some to get, you know, their cost growth less under control if one thought that was necessary. And yet just arguing over some big number and it's sustainable, unsustainable, that is not helpful. And frankly, if you look at the federal debt, it has come down ever so slightly during the Biden administration. Now, I don't want to ding the Trump administration because they were the ones that went, you know, and Congress in a bipartisan way went way in on the COVID fight with CARES and other measures. So that's not, but Bidenomics has not cranked up the federal debt. You know, so again, facts are great. Let's bring them.
Claudia Sam, we've got to leave it there. It's wonderful to hear from you. Claudia Sam there of Sam Consulting, giving us a lot to think about. So let's deal with the two issues. One, the Federal Reserve. Claudia thinks they should be cutting right now, or yesterday, or last month. And then the issue around Bidenomics and the lack of communication. The fact that we don't hear from them often, I find really, really confusing. I think we saw it with Brian Deese when he was the National Economic Council Director. It was a struggle to get engagement from him. It picked up towards the end, and then he left. Then we've had a replacement who we've barely heard from whatsoever. And I always talk about this with the payrolls report, and this is just an observation of being here for the last decade or so. Every single administration here that I've covered has always put up someone prominent in the White House, an economic advisor, to talk about payrolls every single first Friday of the month. And they've always got a story to tell, and you challenge them in a robust way, and they'll carry on appearing every single month to talk about that story. Larry Kudlow turned up every single first Friday of the month, and it didn't matter how bruising our conversations were, he'd be back the following month to talk about how strong he thought the economy actually was. I don't get that from this administration at all.
I'm not going to speculate on exactly why that is. What I find interesting, though, is the split in the Democratic Party. There are splits in the Republican Party, there are splits in the Democratic Party about what that message should be. There's a question around whether you recognize the pain that people are feeling for paying the greatest proportion of their incomes on food going back decades, or do you say things are really good? You guys should be feeling it, right? This is the tricky thing at a moment where there is not very much agreement on economic policy, oil policy, et cetera, within the Democratic Party.
I think to Claudia's point, what you see from the president, he's going out and talking to voters directly. The campaign is now getting on TikTok. What it feels like is he campaigned from a basement the last time around, and now it feels like he's going to be campaigning around traditional media. That is my take, especially given signals like not sitting down for the traditional Super Bowl interview.
And less comments on cookies and stuff like that, you know? It's your opportunity to talk about lower gasoline prices.
Can I
talking about.
Yeah,
I don't want to see that.
Come on, please.
Not doing a John Stewart impression. Not doing that at all. In the next hour, Cameron Dawson of New Edge Wealth, Mike Schumacher of Wells Fargo, and the Marriott president and CEO, Tony Capuano from New York City. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The consumer has been trading down.
But you can certainly see that there is some stress on the low-end consumer.
Consumer discretionary category is expected to show improvements for all of 2024.
I think the consumer is a little bit more stressed than what they were before. If the consumer starts to roll over, then I think we go back to talking about recession.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market on the S&P 500 down about 0.2% on the S&P after a couple of days of losses going into the big earnings report a little bit later. The last couple of days, though, the upgrades to the previous upgrades. Need to talk about them right now. UBS raising its S&P 500 price target for the second time since December. Only a few days since Goldman Sachs did the same thing since late last year. David Costin at Goldman looking for 5,200, saying it's all about the earnings. And Lisa, Jonathan Golub at UBS now looking for 5,400, saying they quite simply weren't bullish enough.
Which is the reason why you're probably going to get more of the same, especially as we climb past a lot of the targets that people had previously. Is it coming, though, from big tech, or is it coming from the rest of the complex? And if it's coming from the rest of the complex, as we were hearing from John Stoltzfus earlier, then does it really matter that much with NVIDIA? I mean, yes, it does, but everyone's been saying it's the make it or break it stock. Goldman Sachs saying that this is the most important stock in the whole world. It is at this moment, but is it going to be just sort of, okay, they keep doing their thing? I
love how nervous you are about saying anything about it, just in case it blows earnings estimates out of the water.
Don't call
a little
me
bit
out
later
on
this
that.
afternoon.
Come on.
I can just hear it. I do it sometimes too. I can just hear it in the voice.
You're not
you know
wrong.
that someone's going to watch this show back at about 5 p.m.
100%.
this afternoon and be like, Bramo, what were you saying about NVIDIA? NVIDIA, AMH, the big one, a little bit later.
Well, Barron's is the most closely watched earnings report they've had in their 3 decades. So to Lisa's point, yeah, you need to be watching it. I am interested about what NVIDIA has to say, what Mandeep was talking about in China, maintaining their presence in China. How long can that last given the competition? And where is the growth coming from? But I got the sense from Mandeep, I think, Jonathan, you got the similar sense. He would say today would be a seller of that.
He said basically, and my word's not his because he danced around it, he just gave me the impression that he thought today was a sound the news event for this stock, that we've gotten so used to double-digit beats and raises that this market, you could sense it in this market too. I mean, look at the price action over the previous 3 days with NVIDIA, softer this morning, lower.
Here's the issue, profit margins. How long can they keep charging premium charges to companies that are cloud computing operations that are going to be pushing back at some point? That's really going to be the main issue that people are looking for. I just want to know, is this really going to make or break the entire world's market? I mean, this is basically what people are saying, and that's the reason why I was pushing back on that, because more and more people who are bullish are saying there's a broadening out. Does somehow that narrative completely get upended if NVIDIA disappoints?
MH was mentioning China. Is it easier to talk about Chinese equities? Given that you know that people can't sell at certain times of the day now. If you are just joining us, I want to do this story again. I think it's absolutely amazing. Based off some of our reporting here at Bloomberg, China is banning major institutional investors from selling more shares than they buy during the first and last 30 minutes of trading. They're reportedly going a step further. They've created a task force with the nation's stock exchanges to monitor short selling and issue warnings to firms that profit from the wages. So it's okay to lose money on shorts. You just can't make money on shorts.
The concept of markets in China is slightly different than in the United States. And that's sort of one of the factors behind why some people are saying it's uninvestable, and maybe one of the reasons why it's lagged behind. The idea that if you're a quant fund and you happen to sell suddenly, you get banned from trading for 3 days, might raise concerns about the ability to play in this market. I'm just saying, theoretically, because otherwise, you know,
Sure.
maybe people like this as a trade.
That was the most diplomatic Bramo I've seen in months.
I'm trying.
Months.
Thanks.
It's a good try. Equities right now, negative by 0.2% on the S&P 500. In the bond market, yield to look like this, down a basis point, 426.16. 108 on the euro, basically unchanged. That currency pair negative by almost 0.1%. Coming up this hour, in just a moment, we'll catch up with Cameron Dawson of New Edge Wealth, looking ahead to NVIDIA earnings. Later on in the hour, Anthony Capuano, the Marriott CEO, on the state of the US consumer and a whole lot more. And we'll speak to Mike Schumacher of Wells Fargo on the Fed's path forward. This is refreshing, why he believes we haven't priced in enough easing, Lisa. Not someone who thinks we've priced in too many cuts. He does not think we've priced in enough.
He thinks once they start, it's going to be 200 basis points, boom. And sort of this is a question, why are they going to start? If they're going to start just simply because of disinflation, are you going to see 200 basis points, boom? Or are you going to see something that's more measured? Or is there weakness down the pike? And that's really one of the big divides right now.
Mike Schumacher later this hour. We begin this hour with our top story. Tech pulling stocks lower ahead of the big earnings report of the quarter. NVIDIA coming up after the close. Cameron Dawson of New Edge Wealth writing this. Tech does appear to be losing a little momentum. It has had many of these moments over the past year, with each digestion pulling back to trend and then rebounding higher. Cameron, I'm pleased to say, joins us now for more. Cameron, great to catch up with you as always. Just how important is this release a little bit later?
It's certainly important in the context of sentiment, because we do know that it has enlivened a great deal of bullish sentiment. You look at flows into tech, and they've been absolutely extraordinary from a sector basis. Every other sector has had either flat to outflows, whereas tech has gone through the roof. It's also very expensive, so it means there's a high bar for upside surprises. You note, though, that tech is still in an uptrend. So we've had these little sell-offs. They pull back to trend and then keep on marching higher. The question is, does this digestion period actually lead to a more prolonged period of digestion where the uptrend might be challenged? That remains to be seen.
We joked in the previous hour it's 4% of the S&P 500 and 99% of the enthusiasm to buy stocks. Does it really set sentiment that much for you?
We would hope not, but I think that at the end of the day, it's the encapsulation of so many hopes and dreams within this market. If we think about it as the effective, it's all about productivity and how much we're banking on the idea that you can see margins being up to so much, that you can see a cyclical upswing. So much is being distilled into this one name that clearly, if you do see a disappointment, people might be a little bit less willing to bank on that big upside.
So from your perspective, how do you trade around this, given the fact that you don't want to knock this sort of incredible powerhouse? At the same time, you're getting a little nervous.
I think that we have to be very disciplined about chasing the market too much here. Given the fact of where positioning is, we know it's now into the extreme or stretched territory in aggregate. Valuations being stretched, sentiment being stretched. None of these things necessarily mean anything about short-term returns, but they are very powerful for 2-3 year forward returns, which just says that you have to stay disciplined about valuations. You can't chase. Doesn't mean that there's not opportunity. There's lots of opportunity within this market. It's just that those very expensive areas are places where you need to ask yourself, is it justified?
How much is this nervousness about going with the crowd? I mean, we heard that from John Stoltzfus, this question around he gets nervous when everybody comes to him. And I know that you've been more cautious for quite a while, and now you're sort of saying, well, you can't knock some of the valuations, you can't knock some of the earnings. Does it make you nervous that everyone seems to be flowing in the same direction, but you can't argue against it?
Well, our caution, the way that we expressed it, was by being neutral equities and focusing on quality, to say that we want to be invested through a cycle, and so remaining fully invested, but focusing on very specific parts of the market. But the point on positioning is very important, because we have seen multiple times in recent years where positioning becomes a risk in and of itself. Look back to 2018, look back to early 2022. When you get to the point of max positioning, everybody on the same side of the boat, the market has a very high bar to jump over, and it does not take kindly to downside disappointments.
Looking ahead to NVIDIA, worried about downside disappointments. Let's talk about the economic data. Upside surprises last week. Hot CPI, hot PPI. We were talking about it earlier this week, late last week, whether that is good or bad news for this economy, good or bad news for this market specifically. UBS's Jonathan Golub wrote this yesterday. The market sold off on that data. Quote, our work indicates these demand-driven readings are constructive for future returns. Is that hot inflation data good or bad news for this stock market?
Typically, higher inflation is better for corporate earnings. Revenues are nominal numbers, so higher inflation would suggest better revenue growth. But what I'd say to this earnings-driven upside is show me the revisions. We have not seen earnings revisions be broad. They're all concentrated in the Mag 7. Earnings for the Mag 7 are up 25% over the last 6 months. For the S&P 500, earnings revisions are flat. But for the equal weight, that average stock, they're down 5%. So we can talk about all this great economic data, but at the end of the day, the market is narrow, not just in its leadership, but in its earnings revisions. So we'd like to see that translate into better earnings, not just for a couple of names.
Which raises the question about which data to pay more attention to. John's talking about CPI and PPI, but retail sales came in really negative, a lot weaker than expected. We're about to be speaking with Tony Capuano, the CEO of Marriott. What are you curious to know about the consumer that you see that's been raising some alarm bells for you?
There is one wrinkle in the consumer data, and it's delinquencies. And I would love to know if delinquencies are a sign of trouble to come. It's very rare that you would see delinquencies move up as much as they have outside of a recession and during a time where the labor market is actually tight. So when we look at overall consumer, we say still healthy, but what does that rising delinquency say about stress, maybe in the lower end of the consumer where you're really starting to see them get pinched?
Final question. Do you want to buy the Open in China tomorrow?
Yeah. Well, I know I can't sell it.
Does it get easier now? I do wonder, does everyone just sort of bid up things at the Open?
I don't get the sense that that's necessarily the response. Cameron, you could weigh in. Is that sort of the response that you would do, is just pile all in China?
There's just so much uncertainty from a policy perspective. I think we've said it as that we're not in the business of catching falling knives in highly uncertain regulatory environments. So China's a tough one, but we do ask the question, we're underweight EM. At what point do we need to reconsider that, given that China's such a big weight in the emerging market index?
It's like Hotel California. You know, you can get in, but try getting out.
Quite literally, you can't.
Exactly. So that sort of raises this question, right? And Cameron just answered it.
Cameron, thank you. It's good to see you. Cameron Dawson there of New Edge Wealth. Broader equities, stateside, equities right now. Are we going to do China equity checks anymore over in Asia? Will we carry on doing that?
Well, sort of like, quoting Bitcoin.
Equities right now on the S&P, a negative by 0.2% on the S&P 500. I think we spent the last 10 years people complaining about central banks and rigged markets. Look at what's going on over there.
Okay. Well, hold on a second. When you talk about rigging markets, there are other levels of rigging markets. There's banning of short selling. There's owning the entire market, if you look at Japan.
There's just banning selling.
There's banning selling. There's quantitative easing. There's buying swaths of bonds. There's all sorts of manipulation we can talk about.
Absolutely. It's been a story of the last decade or so. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. plans to unveil sanctions against Russia on Friday following the death of opposition leader Alexei Alexei Navalny. President Biden blames Putin for the death of Navalny, who had been imprisoned in the Arctic, while the White House says the sanctions include a substantial package of financial penalties which target Russia's defense and revenue sources. Hedge funds pared exposure to Mag 7 in the fourth quarter, say Goldman Sachs. The firm looked at more than 700 funds with $2.6 trillion worth of equity positions. The only Mag 7 stock that saw an increase was Amazon. HSBC shares are falling. Fourth quarter profit plunged by 80%. The bank took a $3 billion impairment charge on its holding of China's Bank of Communications. CEO Noel Quinn also announced a $2 billion share buyback. It was supported by higher global rates, but HSBC is still facing headwinds on one of its key markets, China. That's your Bloomberg Brief, John.
Hey, Danny, thank you. Up next on this program, the state of the U.S. consumer.
The consumer has been trading down. I mean, we do continue to see that. It doesn't mean it's all bad for the consumer out there. I do think that the consumer is choiceful, as Walmart said, and it has been able to spend where needed.
That conversation just around the corner, live from New York City. This is Bloomberg.
Was going to keep Rain World Cup. This is a three as the economic picture covering the intersections of Hollywood, Silicon Valley, and
beyond. What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well.
Paul from the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurize the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
per available room, which is the metric that we use to evaluate the strength of the business, increase about 15%. Single-digit growth here at home in the U.S., strong double-digit growth internationally. Now, some of that is because those markets opened a little more slowly, so they benefited from easier year-over-year comparisons. But even as we look into 24, we guided on our earnings call 3 to 5% global RevPAR growth this year. Again, disproportionately stronger internationally.
Let's sit in international just for a moment. So UK economy's contracting, Germany arguably in recession, Japan in one, China struggling. You don't see it in quite the same way, and I find that really, really interesting. Are you seeing a bounce back there? What do you actually see, in which region are you more constructive on?
So Asia broadly is really strong from a travel perspective right now. We think about Asia in two buckets, if you will. What we call APEC, Asia Pacific excluding China, and then Greater China. Greater China is fully recovered to pre-pandemic levels, although interestingly, largely on the shoulders of domestic demand. If you look at cross-border airlift, it's only about 60 or 70% recovered to pre-pandemic levels. So we actually think there's still a fair amount of upside to the China recovery story as more and more cross-border travel recovers. I'll be in China in 2 weeks, and I'm anxious to see how it feels in terms of international travel. I was there maybe 9 months ago, and it felt very domestic. I was in markets like Changsha and Chengdu and felt like I was one of the few international travelers. So it'll be quite interesting. When you look at the APEC markets, they are booming. Thailand is very strong. Singapore is very strong. I was just in Vietnam, really strong both from a development perspective and an inbound travel perspective. And the last comment I would make, you've seen China create some visa-free travel zones across the APEC region, and that's really impacting demand patterns.
I have to go there. We talk about banning iPhones. Is there a problem with staying at a Marriott hotel in China?
No. It's our second largest market. We just opened our 500th hotel in China. We've got another 400 hotels in the pipeline behind that. The vast majority of our portfolio is China-owned. The vast majority of our workforce is Chinese. So we see great strength in our China business.
Moving forward, I am curious about where you see the demand coming from. I know you've been expanding into mid-scale, extended sale, mid-scale types of accommodations. Is that because you see the growth in actually lower income and medium income families and not as much in the luxury sector?
That's a good question. My view is it's not binary. We have the largest luxury portfolio in the industry. We have more than 500 luxury hotels globally, another 250 in the pipeline behind that. We saw revenue per available room in the luxury portfolio actually grow 10%. I was listening to the prior segment and hearing about trade down. We're not seeing that from luxury. Luxury continues to be a really strong segment for us. Our entry into mid-scale is really intended to open the aperture. Our objective simply is to try and capture as broad a segment of the traveling public as possible, and entry into mid-scale just allows us to capture a broader segment of the traveling public.
Can I ask you, what is mid-scale? Can you describe that? What is the difference between, say, mid-scale and luxury? And what do you call the other end of the scale?
So luxury is obviously from a physical product perspective and a service delivery perspective, everything you could hope for. Mid-scale, simply put, cheap and cheerful, right? Simple, high-quality facility, but simply delivered. Minimal services, great bed, great shower, great Wi-Fi, but relatively limited services.
When you're looking at that mid-scale, your competitor IHG was on yesterday and talked about next 10-year projections. U.S. middle class will grow 100 million. China's middle class, 200 million. When you look at building out the middle class around the world, where is it? Is that in China?
It's everywhere. I mean, I think across Asia, you see really strong growth in mid-scale. You see it here in the U.S. And that consumer, we want to get them exposed to the breadth of our portfolio early. We've got nearly 200 million members in our loyalty program, Bonvoy. By entering the mid-scale segment for the first time, it gives us the ability to show a segment of the traveling public the breadth of the portfolio who perhaps isn't aware of the 30 brands that make up Marriott today.
All I can say is that side of the table is the luxury side, and this is the cheap and cheerful side.
See, I can take you off.
Yeah, exactly. It's sort of a question of.
I love it. Tom's not here anymore, so you beat up on me instead.
Well, I mean, am I wrong?
Tom would be on that.
I know. I miss talking about Venice with Tom.
No, it's fine.
I'm not going there.
Let's move on. There is this question, though, about what Cameron Dawson was saying, which is we are seeing delinquencies tick up. We are seeing retail sales come in weaker than expected. We are seeing signs of cracks on the margins. Are you not seeing it? I mean, yes, because you're offering a wonderful product and et cetera, but is it partly because people continue to prioritize travel in a way that they just didn't before the pandemic?
I think that's exactly right. One of the great benefits of our credit card partnerships with JP Morgan Chase and American Express is we have really deep insights into that consumer spending. And even prior to the pandemic, what we saw maybe with younger demographics was a shift towards or away from spending on hard goods towards spending on experiences. It appears when we look at that data today, the pandemic acted as an accelerant to that trend across demographics. And as a result now, perhaps the consumer saw or learned during the pandemic, I didn't buy any purses, I didn't buy any watches, I didn't buy any shoes, and I didn't miss it that much, but I sure missed traveling. And so I've prioritized that disposable income I have, and I am seeking the vacation that I missed, the family reunion, the wedding, the trip with friends, whatever it might be. And so we really don't see that decline in travel spending in the data. We just reported fourth quarter and full year earnings, highest EBITDA in the history of the company. As I mentioned, 15% RevPAR growth. Really extraordinary numbers. And what was encouraging to me, the strength we saw was across geographies and across demand sectors.
I miss the service. Can we talk about that? I'm not talking about Marriott now, just for the record. I'm talking about hotels in general. Mm-hmm. You go in, the towels are there. They might be on the floor. I'm usually good about that. I'll put that on the side. I don't want to make too much work for people. But then there'll be this little card that will say something like, we're going green, so we're pulling back on washing things. And I say the same thing every single time I'm in a hotel room. Are we using going green as an excuse to provide less service than we used to at hotels?
Yeah, I think that would be a fair view if you didn't have optionality. And so if your view is, I want fresh towels every day, I want my bed remade every day,
we can still get them.
You can absolutely still get it. But what we hear from our customers more and more is they want the ability to contribute sustainability and have sustainability be a part of their travel choice.
At the high end?
Really,
at the luxury
across
scale?
the board.
Interesting. All right. I rule myself out personally. I think that when I go and you spend that much money, you...
Towels at the St. Regis?
No, I'm not getting into that. If you go to a hotel, 5-star hotel, you spend real money to go and stay there, you want fresh towels, fresh sheets, don't you? Isn't that a whole part of the experience?
I don't need to go into.
How often do you wash your towel at home?
At home, every couple of days, a fresh towel. Every couple of days.
Honestly, I can reuse my towel because I feel like I'm obligated to.
It's the conversation I didn't expect, but ultimately I'm getting to the point about service. Don't you feel like service has pulled back since the pandemic?
Oh, without a doubt. It has been. And it's been sort of an open, not secret, because frankly, there wasn't the staff, which raises this question of whether you can hire enough people and what kind of people you can retain over a longer period of time. It's a good question we can get into.
Yeah. Although one of the things that's been interesting when you've watched the employment reports over the last number of quarters, you see that hospitality has been a disproportionate contributor as our industry sector staffs.
Very true. And I'll say this for the record, staying at my house is not $1,000 a night. Tony Capuano of Marriott International, sticking with us from New York City. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Honestly, the comments I'm getting in the commercial break, this on the Bloomberg terminal, you care more about getting a fresh towel than saving our planet at the hotel. Absolutely. I'm not even disputing that. Bramo wants to know why breakfast is better abroad than it is stateside. More still to come on this program. Equities right now on the S&P 500, negative by 0.2% on the S&P. We're down at 0.4% on the Nasdaq 100. In the bond market, 2-year, 10-year, 30-year. Lots to talk about around the Federal Reserve in the next 24 hours. Tons of Fed speak. Yields are lower by a couple of basis points on a 10-year, 425.37. Down 3 on a 2-year, 458.27. In foreign exchange, I'll just finish on the euro for you. The euro looks like this, negative by almost 0.1%. Let's call it 108 flat, almost totally unchanged on the session. Under surveillance this morning, the #1 stock of the year. Nvidia's much anticipated earnings coming after the close today. The stock jumping more than 40% so far year to date, driving it to a market cap of more than $1.7 trillion US. Booming AI spending driving the chip maker past sky-high expectations for several quarters now. And analysts again have lofty estimates for the company, forecasting sales more than tripled in the fourth quarter. Lisa, what's amazing, we keep raising the bar and they keep beating it.
Because who else is the game in town? Everyone keeps hoarding these chips. But the reason why people say this is the most important stock in the world, it dropped 4.4% yesterday. That is equal to a market capitalization of $79 billion. So if you start talking about a drop like that in a penny stock, it can move any kind of, difference. But if you're talking about a 4 or 5% swing in a name that's this big, all of a sudden you're talking real money.
Tony Capuano with us from Marriott through the next hour or so. We're going to talk about AI just a little bit, Tony. How is this changing your business? This is moving so quickly for us around this table. What's changed for you?
Yeah, so, we've used elements of AI in our business for quite a while. What's exciting to me about AI is its ability to create capacity for our associates. At its core, we are in a people business, the ability for our associates to interact with our guests. And if AI creates more capacity for them to engage our guests, person to person, that's a huge advantage. I was in Cork, Ireland a couple months ago at one of our big customer engagement centers. And one of the things I did is I listened in to customer calls. And travelers have become so sophisticated today. Some of the calls you listen to now, the customer calls and says, I want to go to a beach resort that has a Japanese and an Italian restaurant where I can get two-bedroom suites that's less than a 20-minute drive from the airport. And so for our agents left to their own devices, that's a complex search for them to do. With the benefits of AI technology, they can do that search in an instant, and it gives them more time to help curate the experience for our guests.
How long before a robot cleans your bathroom and makes your bed?
And washes your towels.
And washes your towels for Jonathan Farrow.
Yeah, I hope they don't. It's funny. I had a group of MIT students come visit our headquarters in Bethesda, and I had a young student raise his hand, and he was so excited about AI, and he asked me, he said, can you imagine a day where you can run a hotel with no employees? And I said, gosh, I hope not. right? Because at its core, we are in the hospitality business. I think AI will create capacity for us. Of course, it'll create some efficiencies. It'll allow us to do a better job of helping our guests curate their travel experiences. But we're in the people business.
I couldn't agree more, and I'm so pleased you said that, and I hope that's the case, because I grew up in the hospitality business. My family did, and it would be so, so sad if we did to services with AI, what ultimately globalization did to manufacturing. If you start to really displace workers, and I think that would be horrific.
It raises this question, which workers are going to be the most necessary? What does high touch mean in a new era with new kind of tools?
It's the worry I think we all have about this particular technology. I want to turn to this. Citi handing Jane Fraser, the CEO, a 6% pay rise, lifting her salary to $26 million. The increase comes out of what's been described as the biggest restructuring in decades, with the bank saying it will cut 20,000 roles in a bid to boost returns. The bump falling well short of a counterpart at Goldman, David Solomon receiving a 24% raise there to take home $31 million. Tony, you'll escape this one. I'll talk to Lisa about it instead. Citi stock has done pretty well. Over the last 12 months, JP Morgan, top of the pile. Second place on the street is Citi.
Well, I mean, they've been doing this incredible overhaul and cutting a lot of jobs and trying to streamline the units into 5 different sections. It is interesting that Goldman Sachs raised David Solomon's salary by 24%, even though profit dropped by the same percentage. You know, there is a real question here about pay equity, and we're definitely not going to ask Tony about this in any way, shape, or form. But, I mean, trying to put into perspective $26 million, $31 million for David Solomon, James Gorman, $37 million. Looking at Charlie Scharf and also Brian Moynihan, both $29 million. It's sort of like, what are we talking about here?
You know who might have something to say about that?
Elizabeth Warren?
Elizabeth Warren, the senator from Massachusetts, with this to say on the Capital One Discovery deal. $35 billion Discover financial deal. On a post on X, this is what she had to say. The senator saying regulators should block the deal, shock, writing that it threatens financial stability, reduces competition, and would increase fees on credit costs for Americans. Bloomberg's Mike Shepard joins us now from Washington, D.C. for more. Mike, I think we've all been asking this question. What deal would be allowed in Washington, D.C. these days, given the amount of deals that we've been told probably won't be allowed?
Well, that's a great question, John. And in thinking about our conversation, I took a look back at our own research from our newsroom on what enforcement activity by antitrust officials here in Washington has been. And in 2023, they set a record for merger enforcement activity. That means engagement with companies, and that means even going as far as trying to block deals. It's a great question about what could get through, not only what could get past the enforcers, but what also ultimately could get through the court.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
the past few years, concerns about eggs and milk and everything else costing so much, that we're not going to see any break on those prices because the supermarkets won't have any competition incentive to lower those prices for consumers when they're looking at the shelves.
That's the argument currently. Shepard's going to catch up. Michael Shepard there, down in Washington, D.C. Tony's still with us. Tony, let's talk about politics. This will be the worst of this conversation, I promise you. So Choice Hotels is after Wyndham, and they're basically saying that this shouldn't trigger antitrust because big players like you are going down market. What would you say back to that?
Well, I know what you know that's been reported about this potential acquisition. I mean, I think about the report we just listened to. The Wyndham board has reportedly indicated real concerns about the regulatory challenges of a deal like this. Certainly, that deal, when you contrast it with the deal we did with Starwood, which was a global deal across multiple quality sectors, a Choice Wyndham deal would be much more concentrated domestically and much more concentrated in the lower quality tiers. So given the current environment for M&A deals, it would, it's probably a fair assertion from the Wyndham side to question the regulatory challenges.
There's a question about how much you factor in the regulatory environment when coming up with expansion plans. How much you prefer to go organically rather than make acquisitions as a result of the fact that not a lot of things are getting through.
So it's interesting. All the big global brand companies have a different point of view about how to expand the portfolio. Ours has been a hybrid view, and I think time will prove that's been the right strategy. We talked a little bit about this on the fourth quarter earnings call. When I look back over the last decade, set aside Starwood, which was a transformational deal, but when I look at brands that we've added through bolt-on acquisitions like AC Hotels or Gaylord Hotels, I'm elated that we did these small M&A deals. At the same time, I think about the launch of Autograph Collection or Moxie Hotels, which were organic platforms we added. The combination of those two strategies has served us very well. And I think that'll continue to be the roadmap going forward.
Mike Shepard mentioned that last year for this administration, it was a record in terms of breaking up, a record in terms of antitrust enforcement. Do you expect the regulatory environment to change if we were to see a new president?
Yeah, it's a good question.
New president?
If President Trump comes back, I think the expectation broadly of the business community is it would be a pro-business environment, but it's anybody's guess.
Pro-business at home and maybe tougher abroad, which introduces the subject of China. Lisa mentioned it earlier. I think we need to go back to that and build on it. You remember back in 2018, the website in China was shut down. It was a mistake, an error, sending out, I think, an online survey at the time that listed Tibet, Hong Kong, Macau, Taiwan as separate countries. Got you in some hot water. As a CEO, as you know, sometimes you have to be a diplomat. Is it getting harder to be a CEO of a multinational company, given the political backdrop at the moment?
Yeah, it is. I wish I could tell you the world was getting simpler to navigate. We're in 139 countries today. We've got another 20 some odd countries in the pipeline coming shortly. So it is complex to navigate. The good news is the company will celebrate its 97th anniversary this year. Our founders founded the company on 5 core values, and those are the values that guide us. One of those core values is acting with integrity, and I think if we follow those core values, for the most part, that'll help us navigate this ever-increasingly complex world, but it is certainly challenging.
I'd love your view, just speaking about China. We talk about how businesses don't have conviction to go there, to make investments, to expand. We certainly see this in the financial space. We see this in the tech space. Why is it so different for Marriott?
Well, so, it's funny. I've had the opportunity to spend a lot of time with Secretary Raimondo, and I was thinking about your prior guest, who I know has some history in ballet. My wife and I were the chairs of the Washington Ballet Gala, and we had Secretary Raimondo as a speaker at our event. And she talked about the importance of countries finding common ground to keep the dialogue open. And she talked about the arts, and she talked about travel as relatively non-controversial areas where they can continue to talk. You likely saw when she came back from her official visit to China, she announced a joint U.S.-China tourism summit that'll happen early this year. And so I think travel is an area where there is some common ground between the countries, despite the complexities of the relationship. And that creates real opportunity for us for growth.
When it comes to geopolitics, before the COVID-19 pandemic, cybersecurity was the big issue for the hotel industry. And a lot of that had to do with this, and you were caught up in this Chinese espionage infiltration. Where's the industry now in terms of cybersecurity? Because now it's just not just China, it's Russia, it's actors in the Middle East.
It's a top priority for us. We make significant investment in doing everything we can to secure our cyber environment. We're coordinated with law enforcement. We're investing in internal resources. We work with the CrowdStrikes of the world. We do everything we can to harden that environment. But as I've heard you talk about on the program, there are a lot of bad actors in the world that are doing everything they can to try to penetrate those environments. And our objective is to secure our own data for our associates and our customer data, because we collect an extraordinary amount of customer data.
Tony, this has been great. You're going to stick with us. We're going to talk about interest rates in just a moment as well. Tony Capuano there of Marriott International. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Here is Danny Berger. Hey, Danny.
Hey, John. The U.S. is said to have told its allies that Russia could deploy a nuclear weapon or a mock warhead into space as early as this year. Sources say Moscow is developing a space-based capacity to knock out satellites. A nuclear warhead in orbit would violate the 1967 Outer Space Treaty, to which Russia is a signatory. Russia says it has no plans to deploy nuclear weapons in space. Shares of Glencore are falling after the company reported a steep drop in annual profit as prices spike and swings in commodity markets eased. The commodities giant also slashed its dividend to $1.6 billion for the first time in several years and did not announce a new share buyback program. Amazon shares, they are up in the pre-market. The e-commerce giant is being added to the Dow Jones Industrial Average next week. Amazon will replace Walgreens Boots in the index. Another change, Uber will replace JetBlue in the Dow Jones Transportation Average. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, Fed Minutes coming up.
The best way for the Fed to proceed is gradually. Just do something gradual, because they really are pushing. They do not necessarily have the luxury of time, given the strength of the economy. It may not stay.
That conversation up next, live from New York City this morning. Good morning.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Another day of losses potentially on the S&P 500, pulling back just a touch. No drama. We're down about 0.25% on the S&P. Yields are down by a single basis point, 426.16. Under surveillance this morning, Fed minutes coming up.
The best way for the Fed to proceed is gradually, right? It's much worse for them to get into a crisis and have to cut 200 basis points all in one day. 25 basis points every other meeting. Just do something gradual because they really are pushing. They do not necessarily have the luxury of time given the strength of the economy. It may not stay.
Here's the latest this morning. The minutes from the Fed's January meeting due at 2 p.m. Eastern Time as investors look for guidance on when the central bank will begin to reduce interest rates. Traders seeing little chance of the Fed cutting before June after hotter than expected inflation data last week. Mike Schumacher of Wells Fargo thinks the market is now pricing in too little easing. When the Fed eventually does start easing, we think the market quickly will price in 200 basis points over the subsequent year. Mike Schumacher joins us right now. So, Mike, this is refreshing. Just as everyone starts to run to the other side of the boat, you're leaning in hard. You don't think we've priced enough easing. Why is that?
What happens is we're not really sure when the Fed goes the first time, and I think people are too fixated on that. Is it May? Is it June? Is it July? For most of your viewers, it simply doesn't matter. The bigger takeaway is that once the Fed goes that initial time, I think people in the market will say, aha, they're in easing mode, it's a cycle. We know how cycles work. They usually go 200 basis points pretty quickly. We should price that in. And today the market's priced for, call it 120 basis points from June of this year to June of next year. Just not enough.
Are you more cautious then on the economic outlook and more optimistic the Fed will meet that weakness with more aggressive rate cuts?
Actually, our econ team is fairly positive. They think the U.S. economy has been underestimated for some time now. You look at the data the last couple of weeks, they've obviously been scary with non-farm payrolls, with CPI. Maybe they're quirky, maybe they're not, we don't know yet. But as far as the core trend of the economy, it's pretty good. But really, from the Fed standpoint, it's got a lot of room here. It's got Fed funds substantially above 5%. It's got real yields that are very, very high. It's a key point. The Fed's going to push back and try to say we need to take out some insurance against future economic damage. So it's not so much we worry about the economy today. We worry more about the economy in 12 months' time if the Fed doesn't come in fairly aggressively.
Mike, does this mean that you think that the inflationary pressures really were, I hate to use it, transitory, and that basically they are dissipating and we're going back to a pre-pandemic inflationary type of regime?
Probably a bit more aggressive than pre-pandemic. A lot of people have talked about nearshoring, onshoring. I'll leave that to your hotel guest. He could certainly speak to it better than I can, but I suspect that's going to drive the trend level, the equilibrium level, higher than it had been pre-COVID, but going back to something closer to pre-COVID levels. So maybe it's low 2s or even 2.5% for core inflation. Something like that on a run rate makes sense to us.
You set him up, so I'm going to go straight to him. Mike, we'll leave it there. Mike Schumacher there of Wells Fargo. Tony Capuano of Marriott still with us. So, Tony, you were the Chief Development Officer before you were the CEO. Let's talk about interest rates. What share of hotel owners right now are struggling or facing difficulties refinancing properties because of what's happening with interest rates?
So it's an interesting question. When we reported earnings, one of the things we highlighted, we signed more organic rooms in 2023, 164,000 rooms, than in any year in our history. And so that might suggest to you that it's a vibrant growth environment. Our pipeline, our global pipeline, has over 570,000 rooms in it, another all-time high. But there's a couple caveats there. About 2/3 of those 570,000 rooms don't necessarily need financing. Either they're already under construction and financed, they are conversions of existing properties, so they don't require financing, or they're in a part of the world, much of Asia Pacific, Middle East, where they don't require conventional financing. Here at home, where about 90,000 of those 164,000 signed rooms are located, financing is clearly a challenge. It's less about interest rates. Of course, a higher interest rate environment squeezes the yields on new construction projects. But the biggest impediment right now, if I had been with you a year or two ago, I would have talked about supply chain interruption. I would have talked about the construction cost environment. Those are still issues, but they've faded a little bit. It's really the availability of debt financing for new construction. Most of our owners are long-term owners. They're not trying to time their construction start over a quarter of a point move in interest rates here or there. They're going to hold these assets for years, if not decades. But it's just the availability. There is, in the regional banking system and even some of the national banks, a concern about what regulatory requirements may be coming down the pike in terms of balance sheet requirements. And as a result, there's a reluctance for origination of new debt.
Which means that you're in a pretty great position when it comes to setting prices for rooms, because it means there isn't going to be a lot of other competition that's going to be built and brought to market. How much pricing power do you still have at a time where we really don't have a sense of what inflation is going to normalize to?
So in general, if you look over a long period of time, average daily rates relatively track with inflation. It depends on booking windows. So group business, for instance, tends to book a little further out. So there's a little bit of lag with inflation. But in general, over the long haul, we track with inflation. Average rates are part of the calculation of inflation. So we think we still have pretty good pricing power. What was interesting during the recovery, as you point out, we've enjoyed as an industry historic low levels of supply growth, particularly here in the U.S. And as a result, particularly in leisure destinations, we've had remarkable pricing power.
Away from pricing and just back to interest rates for one further question, if we can. How are you helping those owners that are struggling to refinance debt? Are you allowing them to defer CapEx, do fewer repairs? What are you doing to make the situation a bit more comfortable?
In the sort of the heat of the pandemic, we really came to the other side of the table with our owner and franchise community and did everything we could to help them navigate this existential threat to our collective business. We allowed, in some cases, we partnered with them to talk to their lenders about tapping into their reserves for furniture, fixture, and equipment replacement, to use that to help sustain them. We helped them negotiate extensions with their lenders. Now that business has recovered, we're helping navigate with them. Okay, many of these properties need capital reinvestment. And we're trying to, I wish I could tell you there was a formulaic approach. It really is much more bespoke. We're looking at the circumstances with each of those owners, each of those franchisees, what their operating track record has been, and trying to come up with an approach by product.
We've got about 60 seconds left. I want to squeeze in this question. The future of cities and the post-pandemic reality for some of them. Downtown San Francisco, parts of New York City. At times they're like ghost times. Some people might consider them to be crime-ridden as well. We won't get into the politics of that. We can just talk about the reality of it. Is it getting harder to stay in certain locations in this country now?
Yeah, so, I mean, it's interesting. I stayed here in New York last night. It was tough to get a room. New York is booming. New York is back. What we tend to see in urban markets, those markets that can benefit from this idea of blended trip purpose, where folks are tacking on a couple of days pre or post business travel for leisure pursuits. Those are the urban markets that have recovered most quickly and are thriving. Those markets that are really sort of traditional core business destinations that tend to get pretty quiet during the weekend, they have a longer road to recovery.
Hey, Tony, this was great. We should do it again. It's just fantastic to see you.
I'll bring breakfast next time.
We would love that from the St. Regis if possible. Thank you, sir. Tony Capuano, the CEO and President of Marriott International. Coming up in the next hour, Binky Chadha of Deutsche Bank, Vijay Rakesh of Mizuho, Stephanie Roth of Wolfe Research, and Bloomberg's David Wells from New York City. This is Bloomberg.
Ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Need the Fed to start cutting. We think that starts in June.
I thought we'd have 3 cuts this year. I'm probably going to dial back on that.
I think that they are sticking to their slower to lower interest rate mantra.
They've pretty clearly told us that they're not going to pull the trigger in March. So by the time May, June rolls around, we'll have a lot more data on everything.
The reality of the situation is they just continue to do nothing and promise they're going to cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Primetime Binky Chowder in the commercial break. We'll leave it in the commercial break, Binky. Deutsche Bank's Binky Chowder with us in just a moment. Look out for that. Live from New York City this morning. Good morning, good morning. Equity futures on the S&P 500 lower here.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, That's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Video, what Mandeep said is they have something that there's not enough of, and people are desperate to get a handle on that. And at some point, once that starts to become a little bit more normal, then where does the stock go?
I love that it's no longer the S&P 493, it's now the S&P 499. Is that what we're doing now?
100%, wonderful
okay,
one.
That's what we're doing now. Let's check out the S&P 500. Equity futures negative here by a third of 1%. Yields in the bond market down about a single basis point, 426.16. The euro totally unchanged, 108.07. Coming up shortly, Vinky Chawla at Deutsche Bank weighing in on earnings season. Mizuho's Vijay Rakesh on why he thinks NVIDIA will remain an AI leader, and Stephanie Roth of Wolf Research looking ahead to Fed Minutes a little bit later on this hour. We begin with our top story. Stocks inching lower ahead of NVIDIA earnings due out after the close. Vinky Chawla at Deutsche Bank weighing in on earnings season, saying this: earnings growth this quarter is in our reading mixed. Despite the Q4 weakness, forward estimates for Q1 have held up very well so far and point to a return to growth. Vinky, I'm pleased to say, joins us now. Vinky, what for the catch up? We'll leave the stuff at a commercial break. Don't worry about that. Let's talk about the S&P 499. Do you see it quite the same way? This whole stock market is now just down to one name.
You know, it's a question of, you know, time horizon. Clearly, there's certain themes playing out, and you know, at this stage, yes, I mean, it makes kind of sense that we focus on basically, you know, the most prominent member.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurize the handle, the gel flows through the reservoir up to the head of the razor, coating the blade, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision, that's an important step for me, and willing to succeed as I want it to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Look at the PMIs and look at GDP growth. I mean, you have, so, you know, the survey is being filled out by somebody and the data is being collected by somebody, and the gap's been huge for a year and a half now.
Our hotel guy was talking about how there's quite a bit of demand.
Is that what we're calling the Marriott CEO now?
Mike Schumacher labeled our hotel guy. But there's this question, the Marriott CEO, talking about a lot of travel demand, particularly even in China, places coming back. Given all this optimism, you have a range of potential S&P forecasts. Are you starting to kick out the most higher end one? I know that's barely English, but the 5,500 kind of target?
So we've, you know, I think it's sort of important to keep in mind that, you know, the equity markets already rallied quite a lot. So I wouldn't say equities are hugely expensive or anything like that, but, you know, there's little doubt that valuations are pretty full. And so, you know, we remain constructive, but we think the upside really comes from earnings. And earnings, of course, depend on the macro forecast, which remains very, very fluid. The 5,100 target that we have, that we put out late last year, is predicated on a house economics view that included basically a mild U.S. recession. But we did lay out, sort of 3 scenarios that cover the range from a mild, slowdown and mild recession in the U.S. to sort of where the consensus was. Deutsche Bank was below consensus at the time. And then there's, of course, what I already mentioned, which is average growth that we've had for the last 6 quarters. I mean, that seems like a rather simple forecast to have, but and it's been more right than any of the other 2, I would say, so far. So if you have the kind of growth that we've had for the last year and a half, then instead of the $250 for S&P 500 EPS that we have in our base case, you're talking about closer to 270. I would say the macro consensus has now moved up and is probably more consistent with, sort of the middle of that range, maybe a little bit less, but I would argue it probably has room to get upgraded. And so the 250 is 5,100, the 270 is 5,500, and so we've clearly moved in that direction. Yeah.
There is a question of, after the bell today, anatomy of NVIDIA earnings watching, and how you sort of gauge just the momentum that gives, not just the tech sector, but everything else. How are you going to look at these earnings? Can you give us a sense of what you're looking for, and then how you shift accordingly?
Yeah, so, there's the fundamental aspect of what we will learn from the earnings. And then there is, of course, the fact that a lot is priced in. The market is very, very long there. And I would say for mega cap growth in tech as a whole, so some time ago, a few months ago, we moved to neutral. We like the fundamentals, but we think more than enough's priced in, and we're really looking for the rally to go elsewhere, and that's really about the cyclical overhang that we were speaking about.
Let's finish up by talking about the rest of the world and the overhang there. I get that the stock market is not the economy, and stock markets don't have to correlate with the GDP of the country that index is located in, but UK GDP is negative. German GDP is negative, Japanese GDP is negative. Talked about this for a while now. China's really struggling as well. What is there to like about the international backdrop, ex-US at the moment?
Yeah, let's take Europe as an example. So, growth's been bad. It's been a year and a half. And the point that I would make is equities tend to bottom basically, about halfway through a slowdown. So you got to think about it from a risk-reward point of view. If, the data is already bad and the PMIs are at 40, is the risk that we move up from here or we continue to go down? I would say the slowdown's well in the price and the market's starting to look forward. So if U.S. growth, global growth is better, then you want to own the cyclical parts and the parts that rely on the U.S.
If I was at home right now, I'd be nervous about the international story pricing in the recovery because I'd be wondering whether it ever bottomed. The DAX was up 20% last year. When did it start to price in the recovery before the economy even bottomed? What happened there?
So the DAX gets a remarkable proportion of its earnings in the U.S. relative to Germany. So
interesting.
I would keep that in mind. So we are interconnected. Yes, I mean the German economy does matter for the DAX, but other things matter too. So you look at Japan. Basically, it's probably one of the markets that is most cyclically sensitive. But I would argue, put a cautionary tone basically on Japan because
on equities or the economy?
On equities, because Japan, like most of the major regional equity markets, gets a very large share of earnings from the rest of the world. It's multinational corporates that are leveraged basically to global growth, and dollar yen matters a lot for Japanese earnings in yen. And so, at 150, where's the risk reward? I think it's very, very clear. And so I would be neutral to underweight Japan.
Interesting. Binky, thanks for that final point. Binky Chandler there of Deutsche Bank with the Nikkei last year up 28%. US stocks weren't the only game in town. It was a big game. Japanese equities were a big part of the story for some people too.
Japan saw real growth. It had been decades of repression, and all of a sudden there was a real optimism around the Japanese economy. Now there's a debate of whether it's all been priced in and whether there is going to be sort of this global hangover, but there still are a lot of people saying that is the new brightest shirt in the long term.
Yeah, maybe some asymmetric risk around this one at the bottom of the screen. Dollar yen at 150. Is downside risk much, much larger than maybe upside potential here on that currency pair?
It would be interesting to know how many people are going into the equities with a hedge on the currency, given the expectation of some sort of shift on the monetary policy side.
Dollar yen unchanged, 149.95, just about unchanged on the session. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Mining giant Rio Tinto is sliding in the London trade. The company reported profits that were down 12% last year on weaker commodity prices. A disappointing recovery in China has put pressure on demand for industrial metals. However, CEO Jakob Stahlholm told me earlier this morning that he's optimistic about the world's second largest economy.
There's a lot going on in infrastructure. There's a lot going on in a number of industrial sectors, not least the automotive with a near explosion in electrical vehicles. So net, the demand has actually grown last year. So we are facing a growing economy.
Despite Rio Tinto's results, the company is boosting its dividend to $2.58 per share from $2.25. The Biden administration is wiping out another $1.2 billion in student loans. About 150,000 borrowers are expected to benefit from today's announcement. The move helps those enrolled in the government's SAVE plan and wipes out debt for those who borrowed less than $12,000 and have been paying for at least 10 years. This pushes the total amount of student loan relief under President Biden to nearly $138 billion over 3.9 million borrowers. Amazon founder Jeff Bezos is selling more of his stake in the company. The billionaire unloaded another 14 million shares worth about $2.5 billion. That brings the total cash out to $8.5 billion. Bezos announced his plan to sell up to 50 million shares of Amazon earlier this month. He finished the transaction in just 9 trading days. That's your Bloomberg Brief. John.
Not bad work if you can get it. Danny, thank you. Up next on this program, the biggest earnings report of the quarter.
Artificial intelligence, or the automation, the production at scale of intelligence matters to every single country and matters to every single industry.
The latest on NVIDIA up next.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Live from New York City, 1 hour and about 15 minutes away from the opening bell. Slight weakness over the last couple of days, bit of weakness this morning as well, pulling back by 0.25% on the S&P. We're down a basis point on a 10-year, 425.96. Later on this afternoon, Fed minutes, and then this evening we'll be talking about this one thing under surveillance this morning, the biggest earnings report of the quarter.
Every single country will become a computer industry, and every industry will become a technology industry. And so artificial intelligence, or the automation, the production at scale of intelligence, matters to every single country and matters to every single industry. Computer technology is going to impact literally every single industry in every single country. And so the markets are going to be quite large and global.
Here's the latest today. NVIDIA results due after the close. Investors waiting to see if the company's 40% year-to-date gains are justified. Vijay Rakesh of Mizuho saying this: we continue to see NVIDIA as the best AI and machine learning play, pushing the tip of the spear in AI training performance. NVIDIA currently dominates the AI server market, and we expect it to maintain its significant market share. Mizuho Securities, Semiconductors and Auto Tech Senior Analyst Vijay Rakesh joins us right now. Vijay, wonderful to catch up with you, sir, particularly on a big day for this company. Vijay, bear with me. I'm going to go with that quote from Margin Call, which is speak as you might to a golden retriever, so do that if you can. This seems to be a stock that everyone talks about and a company that very few really understands. We talk a lot about this so-called H100. Can you tell us what it is and how big the moat is currently around this company?
Yeah, thanks for having me on, John. I think if you look at the H100, it's basically a GPU accelerated training chip that's used in data center or servers. But basically that accelerates the whole training process, is able to take data out of very large data sets and try to glean information and use that for prediction, etc. So it's basically a mega GPU that NVIDIA has. And they have the next version of the H100 coming out this year, which is called the B100. But that's really what is driving the tip of the spear in AI training globally. So they'll dominate that market as you look out.
And the demand for it has been absolutely phenomenal. Vijay, at the start of last year, we were talking about AI as a story for the future. And I think with this particular company, it became real. Every single earnings report, it was beat and raise, and beat by double digits. Vijay, going into this report, we've been trying to figure out what is a real beat today for this company, given how much this stock has run up over the last 12 months.
Yeah, I think if you look at the guide for April quarter, which is where all the investors will be focusing on, I think we are looking for about $22 billion on the top line, with about $20 billion of that from data center. But expectations are probably running much, much harder. I think it's probably in the 25 billion range, 23 to 25 billion. So that's what where expectations are. The one thing I would say is the AI continues to grow very well. Even for 2024, AI is growing almost 90 to 100% in revenues for NVIDIA. That's about almost 80 billion plus in revenues from just data center. That's about 1.5 times what Intel's revenues are today. So very big market for NVIDIA. So.
Vijay, I'm going to bring it even lower. A GPU is a graphics processing unit. I'm looking through and trying to understand how these things are made, where you can have really rapid mathematical calculations at high speeds. Where is the barrier to entry? How high is it for other companies to come in and come up with mega GPUs that NVIDIA is churning out?
Yeah, it's very high because what you're seeing, there are two parts to it. It's not just the hardware, it's the software part as well. And what NVIDIA has done very well is build a very broad training container called CUDA, which can basically port data onto it, use data from anywhere, from AWS to Google Cloud to any of the big mega Facebook Cloud, etc., and use the data to train it. And they have multiple training models. They have a big supply chain, a lot of experience in doing it, and they're able to optimize and train it a whole lot faster. So that plus the hardware, as you mentioned, the H100, B100 that's coming up, drive what's really the whole platform training and AI on it. So for anybody coming in, yeah, the hardware part, maybe you can do it slightly better. You might try to gain a little, share there, but really, where the rubber meets the road is you don't have that software training side of it. You don't have the breadth. You don't have that experience. You don't have the presence in multiple markets that NVIDIA has. So they really have been early to that game, have been dominating the market. And if you look at calendar 24, AI, we've been talking, it feels like for ages now. NVIDIA will do probably 80 billion plus, or close to 90 billion, let's say, this year in calendar 24, versus if you look at, the peers, somewhere in the 4 billion or under. So they are ahead by 10x, 20x versus the peers. So.
We've been talking also about margins and how they're able to charge pretty high prices to cloud providers because there's no other game in town. What about the materials? How do they sort of source some of the things, especially at a time when we talk about electric vehicles and the lithium coming from China? Is there a similar type of supply chain that's underpinning NVIDIA?
Yeah, the manufacturing part is obviously through Foundry, which is in Taiwan, which is TSMC, which is the largest foundry in the world. But where they have a little bit of a bottleneck, and that's getting resolved as well, is with CoWoS. CoWoS is the type of packaging that is done with GPU on the substrate, on the wafer. And so that has been a little bit of a constraint, but that capacity is getting resolved as TSM adds almost 100% plus capacity there. And you are seeing new entrants, Amkor, ASC, potentially on Intel getting into the CoWoS side. You'll probably hear from Intel this morning on their IFS Foundry roadmap. But all those are trying to resolve that CoWoS bottleneck there and improve that supply to the customers, to the hyperscale OEMs.
The H20 chip is their most powerful chip that they can sell to China. What makes it different than their most powerful chip that they're able to sell to anyone else?
I think the H20 obviously is a little bit more, I think the training performance is a little bit more constrained than their leading edge because of all the restrictions that have been put in place. So it's kind of, geared more to the China market, but it's definitely not at the same training performance level compared to the H100 or the B100s coming up, right? So it's basically tuned and constrained for specifically the China market. So.
Vijay, forgive me, we'd like to talk about Tesla as well. It's a company that falls under your coverage. We'll be talking about this a little bit later this hour. Ford had to slash the price of its electric Mustang in the last 24 hours. What's your read on what's happening here? Is this a problem for Ford, for GM, and not a problem for Tesla, or a problem for everyone?
I think it's a little bit of a problem for everyone, and we had a big note on this early in the year, early January, when we did an outlook on the EV space. What's really happening is, obviously, a lot of the low-hanging fruit has been taken by Tesla. I think they've done a very good job of carpet bombing the automotive space, taking that EV market share. So now to get to the next level of penetration EVs, you need to drop pricing. And I think as you look at Tesla, they are doing it. They have a new Model 2 coming out where they can start penetrating the market even more. Let's say if that's a $25,000 ASP model on the Model 2. But for somebody like Ford, GM, etc., the problem is they have to go to that full optimization. It's a catch-22. It's like a chicken or egg. You either scale up, get the volumes that drive the platform costs lower, or start from a lower price, which either way, you're in a bad spot. You're in a bad starting spot there. And so that's the challenge for Ford and GM, is that they had to compete with Tesla, which is a pretty massive manufacturing ramp, huge production scale, much better operating and leverage metrics than Ford or GM, which have much smaller scale and just starting off. But I think GM, as we have noted before, is doing a pretty good job building out their whole battery platform, building out the Ultium platform, and trying to get the cost down. But it's definitely a challenge.
Tesla is just a different beast at the moment. Vijay, wonderful to hear from you, buddy. Always is. Vijay Rakesh there at Mizuho on NVIDIA and Tesla. NVIDIA price target for Vijay, by the way, 825, up from 625 recently, so quite an upgrade from him. Tesla, we'll talk about it with David Welch a little bit later. The others are struggling here. Ford and GM, struggling on strategy and on execution.
Well, and cutting prices, and Tesla's done that too. How far are they going to have to go, even without necessarily having some of the Chinese auto manufacturers selling in the U.S.? Open question.
David Welch later this hour. Coming up next on this program, Stephanie Roth of Wolf Research looking ahead to Fed minutes. They are coming a little bit later on this afternoon. Just hardly anyone's talking about it. From New York City, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself? I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it. When did you realize that actually photography was your passion and you could make a real difference to our world? You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Stocks down over the last couple of days. This morning we look like this, and good morning to you. On the S&P 500, negative by a third of 1%, down 0.6 on the Nasdaq. This from Andrew Hollenhorst over at Citi. He's calling it carefully crafted minutes. FOMC minutes out today at 2 p.m. agreed upon after the release of stronger jobs. And inflation data should reinforce Fed officials' public calls for rate cuts to be pursued carefully without urgency. More informative will be tomorrow's packed day at Fed Speak, which is, Lisa, what you've basically said. Bauman, Harker, Cook, Kashgari and Waller all on the calendar.
That was very well done. I'd like to hear that again.
List gets longer.
Yeah, but this is basically what are they going to say? And ultimately, they have nothing to lose to keep the status quo, because the status quo seems to be kind of moving in that direction.
Let's turn to the bond market. Yields lower by 2 basis points. The 2-year just short of 460, 459 on a 10-year, basically unchanged at about 427. In foreign exchange, the euro shaping up as follows. Unchanged through much of this morning. 108.04. That currency pair is negative by 0.04%. Under surveillance this morning, the so-called most important stock on earth reporting after the bell, Nvidia. The chip maker facing sky-high earnings expectations. Investors will decide whether the company's earnings and forecasts justify a gain of 40% year-to-date and a market cap to rival Amazon. The company at the center of the AI frenzy, adding almost $500 billion in market value since January. It's not bad, is it? It's not bad.
It's 2.5 Disneys.
It's basically 2.5 Disneys, yeah?
That's basically what we're talking about.
Isn't that what Meta did in a single day?
It did it in a single day.
The market cap of Walt Disney. Which speaks to how insignificant all these other stories are for the S&P 500.
Which is the reason why people don't even care if it broadens out, and the fact that it hasn't been, people are saying doesn't matter. This is the most important stock on earth, and it's going to really determine the direction of everything else. That said, does it really, or is this basically a harbinger of strength that comes on the heels of this as companies adapt to similar types of technology?
I do think beats are built differently at NVIDIA, which is maybe why we've pulled back over the last 3 days or so. Day 4, by the way, we're down now, Lisa, by almost 2%.
Basically just cashing in before you sort of get the release and figure out what's going to happen.
How many double-digit beats can you get? You know,
although
can we get more?
This concept, the conversation we just had with VJ, I thought was fascinating, actually. Because if you think about it, if it's a high barrier to entry, and every single cloud computing company needs this in order to be on the current cutting edge, people can't get enough. You kind of have to think that's the reason why people are so enthusiastic.
Which is why it was the #1 performing stock last year on the S&P, and so far this year, the #1 performing stock on the S&P 500 or the S&P 1 versus the S&P 499.
It's true.
I know. Nikki Haley isn't backing down. Here's the latest on that. The second-place GOP candidate, second place out of 2, vowing to stay in the presidential race regardless of the outcome of Saturday's South Carolina primary, and saying she won't buckle to pressure from frontrunner Donald Trump.
I refuse to quit. South Carolina will vote on Saturday, but on Sunday, I'll still be running for president. I'm not going anywhere.
I'm not going anywhere. Haley's struggling to get a boost from voters in her home state. Trump's leading by more than 25 percentage points. AMH, if this wasn't Donald Trump, if this was any other race, and we had a candidate 30 points behind, who'd been absolutely dominated in the way she has been in the primaries so far, would we even be talking about it?
No, she'd probably be dropping out also and cozying up to try to get the VP spot. But we're dealing with a candidate who's dealing with more than 90 indictments. There's potential he's going to be convicted before the November election. You know, it depends on the timeline. So it feels like, and she would never say this, you know, when she got up yesterday, everyone thought she was going to say, I'm losing the campaign, given the polls. She's sticking around. And this morning, Suffolk University USA Today, 2-1, 63-35. And she says she's going to continue.
So you said it, she won't say it, but ultimately, what is the strategy? What is people saying about this? Is the strategy now just be the last person standing and see if he's forced to drop out of the race?
An alternative if it cannot be him.
Okay, Bramo?
I just think people are holding their breath, hoping that this isn't the reality, that we're doing a repeat of 2020, and it is.
It is. Without a doubt.
Point blank.
It is, which is why I think they still entertain this story so much. I've got no idea what's going to happen. Things can change. Big things can happen. But ultimately, this is it. And the reason people keep entertaining someone who's 30 points behind in the race when in any other race they wouldn't is exactly what you described. The dissatisfaction for a large amount of this population away from the Trump base who just simply don't want it to be these two individuals facing off again.
We talk to executives every day, and analysts and economists, and they want to talk about policy. They want to understand what's actually going to drive better economic conditions and a better quality of life. That conversation is nowhere in Washington, D.C. It's a lot of messaging and a lot of spin, but it's not a lot of trying to really get to the bottom of it, and I think a lot of people are frustrated.
What bugs you more, politics or monetary policy?
Oh, definitely politics. Monetary policy is really fun.
Let's get to monetary policy. Fun minutes from the Fed's January meeting due out at 2 p.m. this afternoon. Investors looking for insight into the committee's confidence in disinflation before they cut rates. Bloomberg Economics expecting the minutes to suggest officials are ready to discount recent hot inflation prints. We'll get more insight into the central bank's path forward when we get a slew of Fed speak tomorrow. Mike McKee's down in Washington, D.C. with a preview for you. Mike McKee, what are you looking for later this afternoon?
Well, I have to tell you, John, we are really honored here on the Bloomberg Fed team to be the opening act for NVIDIA this afternoon. It may last about 2 hours between us and their release, and that may be enough time for people to react to what we're going to get, which may not be all that much. We are expecting the Fed to sort of lay out the conditions under which they might cut rates. But remember, this was 3 weeks ago, so they'll be talking about in the minutes pushing back against markets that have already repriced for when the Fed might move. They'll also be restating probably their view, 3 cuts, and they'll give us an economic outlook, what they saw at the time. This was January 31st, and of course at that time we didn't have the higher CPI, we didn't have the stronger labor market news. So if we get something out of it, it might be some idea of conditions under which they might cut. But since that meeting, we've moved on quite a bit, both in the economic assessment and in what people have been telling us.
Mike, Andrew Hoddenhorst, the city, called it carefully crafted minutes. How carefully crafted, edited will these be, given what's happened in between this meeting and this release?
Well, that's a good question. I don't know as they have to edit it a whole lot because market perceptions have already changed. If you were trying to push back on something, then you might try to push the minutes one way or another to give market participants an idea of what you want them to do. But in this case, the markets have already done what the Fed was wanting them to do, what Jay Powell was talking about at the news conference. So I'm not sure they have to carefully edit these as much as they might in other circumstances.
Mike McKee, thank you. Looking forward to the preview, the appetizer before the big one a little bit later on this evening. Mike McKee down in Washington, D.C. The brilliant Stephanie Roth of Wolf Research with us around the table now for more. Stephanie, good morning to you.
Good morning.
You've been dead on the economy. You said the risk here was upside risk, the potential this economy continues to do okay. How does that shape your Fed call now?
Yeah, I mean, we've been consistently calling for the Fed to be cutting in June. Our base case is that remains. We think that a lot of the inflation data that we saw recently was largely seasonal, and that will reverse in the next couple of months, which will then put the Fed on path to be able to cut in June. Of course, the risks are that it has to be a little bit later, and then you run into election timing, so it gets a little bit complicated. But we very much think that the picture will look different by June.
When you say seasonal, what does that actually mean in practice? What happened?
So I would call it like this January effect. And we were looking for that ahead of the print, and it was even more severe than we were expecting. So what tends to happen is in the month of January, you tend to have annual price increases that go into effect. And what happened, we believe, in this past month is we were just catching up to a strong year of inflation, so that price increases were more significant than the seasonals were prepared to adjust. And that's what we think is the main driver behind the strong PPI, strong CPI, and we should get a reversal in the next month. Then you had OER, which is a whole different kind of conversation.
Though the fact that some of these companies were able to increase prices as much as they did does raise some alarms. And I do have to say, Torsten Slok put out a really good graph today talking about how the share of private consumption spent on services is still 2 percentage points below where it was pre-pandemic. In other words, there still is ammunition to be poured into this consumer economy. How do you sort of factor that in when you start expecting that disinflation to take hold in a more significant way?
We're probably just settling at a new trend. The consumer's now likely to just spend in line with their income growth, which is now running at you know, a more normal type of pace. So we're probably not going to get quite back to that pre-pandemic trend level, and we'll just settle off at a new trend, which would then be able to sort of stabilize the inflation outlook.
So you think that people have found discipline?
Well,
moving on. I do wonder, though, what do you make of the idea of credit card spending and the credit card outstanding and the delinquencies, which doesn't exactly scream of incredible discipline?
Yeah, and it doesn't. In the fourth quarter of last year, we saw credit card spending pick up notably. Our base case is that will slow down a little bit in the first quarter, just because we spent so much in the fourth quarter. We're probably just a little bit tired of all that spending. But outside of that, we don't have this excess savings anymore. That's largely spent through, except for the top income earners, and they're probably not going to spend it. So now it's probably more about you know, nominal income growth, because credit card rates are so high. Yeah, buy now, pay later, that's something that does concern me a little bit. But generally speaking, you know, the consumer's probably just gonna spend in real terms close to 2%.
Out of interest, why does that concern you, the buy now, pay later?
Because there's just not that much rigor in terms of the process, in terms of looking for, you know, whether these people are really able to borrow. It's a lot less stringent of a policy. Right now, it's not that large, but it's possible as this grows, it could become, you know, a source of some negative credit.
I know this is not your base case. Can you just do some scenario analysis with us? If the dual mandate of the Federal Reserve went into conflict, if unemployment started to pick up but inflation was still sticky, what guides you and gives you an idea as to what the Federal Reserve would prioritize at that point, if that was to happen later this year?
My base case is they'll prioritize the unemployment side. If you get to the unemployment rate rising well above 4%, if we're moving steadily towards 4, just above 4, I don't think they'll react. But if we're moving well above 4%, they're going to be looking ahead to what's going to happen to inflation in the future after that, and very much so. You know, it's a lagging indicator. The expectation to be rising unemployment is going to slow down inflation in the future.
You talk about employment, and people say that really holds the key to consumer strength and the economy and just how long this can continue. How much is the hot labor market reports a function of people getting multiple jobs?
Yeah, there's definitely an element of that. And that's one reason why you're seeing significant strength in the establishment payrolls report as opposed to the household survey. I think that's kind of one factor that's explaining some of that. But I also think some of that was seasonal. So going back to all of these seasonal problems that happened in the month of January, we tend to get seasonal strength in that particular month because we tend to lose less jobs than the seasonals are looking for, and that boosts the print. So let's look to the February print and see how much of that was actually sustained.
How much are you going to hinge your call going out the rest of the year based on NVIDIA earnings?
Not much, but what I would say is that you know, what we're seeing is a legitimate investment in the tech space, and this is going to be important for productivity looking forward. Not necessarily today, but in the next couple of years, this could be really important for the U.S. economy, which is going to put downward pressure on inflation if productivity really picks up.
That was the smart answer that Lisa wasn't looking for. Stephanie, thank you. It's good to see you. Appreciate it. Stephanie Roth there of Wolf Research on the Federal Reserve and on NVIDIA as well. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. plans to unveil sanctions against Russia on Friday following the death of opposition leader Alexei Navalny. The president blames Putin for the death of Navalny, who had been imprisoned in the Arctic. The White House says the sanctions include a substantial package of financial penalties targeting Russia's defense and revenue sources. Goldman Sachs says hedge funds paired exposure to Mag 7 stocks in the fourth quarter. The firm looked at more than 700 funds with $2.6 trillion worth of equity positions. The only Mag 7 stock that saw an increase was Amazon. A tie-up between two supermarket giants could be in trouble. Sources tell Bloomberg that the FTC and a group of states will sue to block the combination of Kroger and Albertson. The suit is expected before Feb 28th. That's when an agreement not to close the deal expires between the FTC and the companies. Both Kroger and Albertson are prepping to meet with FTC Chair Lina Khan to persuade that agency not to sue. And that's your Bloomberg Brief. John.
Danny, thank you. AMH, we asked this question earlier on in the show this morning. What kind of deal will they like down in Washington?
Well, you look at Kroger and they're saying, how do you expect us to keep up with Walmart, with Amazon? We need to get a little bit bigger. And they say that this is going to help boost wages, while the FTC and people like Senator Elizabeth Warren say it's actually going to hurt workers, it's going to be bad for unions. But if you look at, like, why can't Kroger and Albertson get through? How the heck is Capital One and Discover going to have a chance?
Exactly, that's such a good point. I also want to know, for Senator Warren specifically, what company would she like to get with another company? Is there any kind of consolidation that she would approve?
Maybe a deli on one side of the street and a deli on the other side of the street.
Even that would be problematic.
But that could be problematic because then they could jack up the prices of coffee.
It's so predictable down in Washington sometimes. We were all waiting for that tweet yesterday, weren't we? It actually came later than I thought.
You thought it would be earlier
in the
day. The one I wasn't expecting was Kroger, and then we had our reporting that the FTC is going to move on it.
It's true. It's the year of the regulator down in Washington, apparently. Up next on this program, EV demand in focus.
We are developing a low-cost EV platform so that we can be a big part of this S-curve when it comes time. And that is, I think, coming in a couple years from now.
That's next on the program, live from New York. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a good, what we saw in the summer.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges.
Britain's next
was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Big afternoon just around the corner, not the Fed minutes. NVIDIA earnings after the close. Looking out for that. Equities right now pulling back just a little bit. We're down a third of 1% on the S&P 500. Two-day losing streak could become three. Three-day losing streak for NVIDIA down again this morning. We'll see how that shapes up a little bit later this afternoon. Yields are lower by a basis point or two. We're down almost 2 basis points to 425.96, and the euro is doing absolutely nothing through much of today. Under surveillance this morning, EV demand in focus.
We are developing a low-cost EV platform so that we can be a big part of this S-curve when it comes time. And that is, I think, coming in a couple years from now. And I think it's going to be a big inflection point for the industry when more affordable EVs come online.
Here's the latest right now. Ford slashing prices for its electric Mustang after sales tumbled 51% in January when tax incentives were removed. The legacy automaker dialing back expansion plans as overall EV sales fell 11% at the start of the year. This ahead of Rivian and Lucid earnings coming after the close, both startups having to contend with the broader slowdown in EV demand. Bloomberg's David Welch joins us for more. David, wonderful to catch up. You're in the heart of this. Can you just tell us what is the big struggle? Is it infrastructure? Is it range anxiety? Is it price, the lack of tax incentives? David, what is it?
It's all of the above. Price matters. You know, there's one EV on the market that sells for under $40,000. It's the Nissan Leaf. It's a compact. Americans don't like compacts. It gets about 200 miles of range. Everything else is pretty pricey, and the early adopters and luxury buyers, they've sort of gotten full up on their EVs. At this point, they're not buying, you know, that many new ones. They've already got one in their garage. And we're trying to reach the mass market here, which is very difficult because the vehicles are expensive, because the charging infrastructure is not there. And, you know, people are pretty happy with their gasoline-powered vehicles. So you got to give them a reason to trade up, and we're just not seeing it yet. And that puts a lot of these companies, particularly Lucid and Rivian, in a tough spot when they're trying to grow volume. You know, the forecast this year for Rivian is 66,000 vehicles, which is decent growth from the 50,000 they sold last year in percentage terms. But 66,000 vehicles is still tiny numbers in terms of getting scale in a march toward profitability and cash flow positivity.
So some manufacturers, David, as you know, leaning towards hybrids. As you also know, General Motors has been reluctant to do that. They think that EVs are going to ultimately take off and they'll be the right place at the right time. You got a sense that maybe that's changed over the last month or so over at General Motors, David. And I think the question we were asking at the time is how easy is it to make that shift on the production line and develop hybrid vehicles to really get to where this market is currently, not where it will be in several years' time?
They have the hardware. They've sold plug-in hybrids in China. They still have the technology, but you still have to go in, re-engineer the vehicles, get the assembly lines to do it. It's not a snap, and that's why you notice GM hasn't said they're going to do this in 9 months or get it done this year. It's more of a probably 2025, 2026 sort of thing. And it won't be in up and down their lineup the way it is with Toyota. I think you'll probably see General Motors do it in the very high volume segment. Maybe they're the Chevy Equinox, which is a small crossover. Maybe they're large pickup trucks, and then maybe a kind of a big family hauler SUV like a Chevrolet Traverse. They'll do it in 3 key areas where they do a lot of sales volume to give customers that option. But you know, it does hurt profitability because plug-in hybrids are expensive to make. You're talking about having an electric system on board, and then you're still having a gasoline engine, exhaust system, and all that sort of thing. So it really does. They are very expensive vehicles to build, and that's why a lot of companies have shied away from doing them, hoping they could go straight into the EV transition, but consumers just aren't coming along.
David, is the Inflation Reduction Act and this administration's policies helping or hurting U.S. auto manufacturers in the electric vehicle transition?
Well, it isn't helping yet because this stuff has just started. The consumer credits are just getting underway. And then there's a lot of money that goes straight to the automakers, but they have to build and sell the vehicles. And so you have 2 problems here. One is the sales have slowed down. And the other one is the companies have had a tough time building them and getting them out the door at prices and with the kind of variety that consumers want. So you're not going to get this incentive money from the IRA until everything starts going. So it's a bit of a chicken and egg issue right now. There's also the other challenge that car companies have, which is meeting all of the requirements and getting all of the minerals that go into the batteries and all of the parts from either friendly trade partners to the U.S. or domestic production so that they can qualify for the full $7,500. And that's why you've seen some of these vehicles lose the credits and then they lose sales because that $7,500 makes a big difference for buyers.
Well, if they started to loosen some of those rules, would it improve the market and help this EV glut?
It probably would, but it was such a big fight to get all of these different incentives approved. And there was very much a desire by Senator Manchin and a lot of Republicans to make sure that these incentives didn't just help China continue to grow its EV supply chain. And I just don't see the flexibility coming in because it was such a battle to get this approved in the first place.
David, can we ask you, is this uniquely an American problem, a US market problem for these manufacturers? Do you see the same thing in Europe, in China, with the adoption rates?
Look, China and European buyers are both, they're buying a lot more EVs. Now, the governments there have a lot more restrictions on where you can buy internal combustion vehicles. The incentives are higher. They've really pushed this a lot harder than the U.S. government has. But, you know, America's a different market, too. You don't have, you know, people who are just living in urban areas where they have access to charging and driving short routes. It's a big country, and people need hundreds of miles worth of charging, or at least they think they do, in order to use an EV in their everyday lives. So there's a lot of pushback based on that. And, Americans are kind of happy with the vehicles they're driving right now. And until we can solve some of these problems, some of these pain points, I think it's going to be a struggle to get the aggressive sales growth that we saw over the past few years.
It's true, you've said it, the demand for the traditional vehicles is still pretty rock solid, sky high in some places. Can we just finish on this, David, what you would be looking for as a next step from some of these manufacturers? We've seen the price adjustments for certain vehicles. We've talked about GM, I would say flirting with the potential, the possibility of leading towards hybrids. What's the next step for you? What are you focused on?
Look, I'm watching to see who's going to be adding more plug-in hybrids and hybrids, because that'll give us a clue as to what they think this transition is going to be like. And the other part of this is the only way you really juice EV demand again is fundamentally changing the vehicles available in the market. So we'll see General Motors and others coming out with usable, lower-priced EVs. We'll have a Chevy Equinox selling for $35,000 later. Gasoline side of their portfolio. To me, that's a big test. Whether or not the mass market, your consumer who has one vehicle, not three in their garage, is ready to go electric. It's $35,000 vehicle, goes more than 300 miles. If it's going to hit, that's the kind of vehicle people are going to want. So we'll see that. Maybe Ford will come out with a lower priced EV in the next couple of years. Tesla has talked about it, but we need to see vehicles in the $30,000 range. And we need to see consumers buy them, and we'll see if they really want them once they do hit the market.
Yeah, that last point is kind of the important point. David, it's good to hear from you. As always, David Welch there of Bloomberg out of Detroit on the latest difficulties that they're having. Big day ahead. Federal Reserve minutes a little bit later on this afternoon. Massive earnings report as well. Final thoughts, Bramo. What are you looking for?
I'm excited that NVIDIA is the main topic. I think it's actually really great because it's the transition. It's this question of hype versus reality. It's sort of the reality on the ground for a company that has dominated so much of the narrative for the past 18 months. To me, that's more interesting right now than Fed policy.
Well, I'm going to take the other end of the fact that I was reading for the Center for Strategic International Studies report last night. Mag 7 companies, Apple, Amazon, NVIDIA, 90% of what they need to get done in terms of processing, manufacturing, done in Taiwan. No one talks about this geopolitical risk that's a major cloud over what is lifting our entire stock market.
It takes me to my final thought. China, China, China. I know we've joked about it. It's amazing to see this country struggle to really put a floor under its equity market. I think the fact that they are potentially coming out, according to our reporting, and basically banning large institutions, major institutions from net selling at the start of the session and the end of the session speaks to how nervous they are about the fundamentals on the ground.
Although we heard from Tony Capuano about the incredible demand to travel, the conflicting signals, that's why it's so strange to me. How do you get a real read on something that is fuzzier and fuzzier?
Follow the policy would be my advice on that one.
Wise.
Coming up tomorrow, Dan Ives of Wedbush on NVIDIA, Kathy Jones of Charles Schwab on the Fed, and Moderna CEO Stefan Bancel and Porter Valet Executive Director Gene Soroka. All of that and a whole lot more. Live from New York City, happy NVIDIA Day.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and
the most important stock on earth, according to Goldman Sachs. Stocks are lower, they're nervous, a little bit emotional. Countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Show investors on edge ahead of two key market-moving events. Fed minutes, remember those? They're taking a backseat to the blockbuster earnings. And NVIDIA is in spotlight, as I say, after the closing bell, a tense countdown. We begin with a big issue. It's all about one thing.
NVIDIA's results. NVIDIA. After the close.
It's going to be front and center.
What will be happening today with NVIDIA will likely trigger some, possibly some volatility.
The options are pricing in probability of a 10% move.
We, like every
concentrated performance.
You've got 40–50% earnings growth coming from Tech Plus.
On the off chance that they underperform, then there'll be some impact to it.
If something goes wrong there, I just feel this cascading sell-off.
NVIDIA's earnings are going to be the story that we all anticipate and wait with bated breath.
It's not just the numbers, it's the emotion that it will invoke. NVIDIA, in case you hadn't got the message, will deliver their results after the bell today. Mandeep Singh joins me from Bloomberg Intelligence. We're expecting revenue to grow by 240%. We have been misdanced before by NVIDIA. So set the table for me, data centers through to sports. Good morning, Mandeep.
Yeah, I mean, look, I think there is no doubt that they have the demand and the pricing right now that's driving a lot of the tailwind in the data center. The question for investors really is kind of assessing how frequently these chips will be refreshed in the data center, because as we know, traditionally, chips have a refresh cycle, whether it's on your smartphone, tablet, or at the data center server level. And right now, this thing is moving at such a fast pace that, by next quarter, they'll have their next line of their chips. And I think investors have to assess how frequently those will be upgraded. So training versus inference, as well as the frequency of refreshes, is what's going to determine, the pace of that data center revenue going forward.
Yeah, and they have that intellectual property edge, as everybody has been saying. Mandeep, thank you very much, setting the stage. My guest this morning on JP Morgan's Monica DiCenzo, writing this. NVIDIA reports this week, and I'm not here to predict the earnings, but I have been advocating that people make sure that stocks like that, which have done so well, are right-sized in their portfolios. My guests are Monica DiCenzo, as I say, joined alongside by Crossmark's Bob Dole. Okay, here we go. You talk about right-sizing, Monica. You talk about right-sizing in the portfolio. What goes through my mind then is, should I be paring back? I mean, this is a stock that's, just the velocity in it has been huge. To right-size, does that mean to downsize or just scale back?
Yeah, I think it depends on your goals. People tend to think in a very binary way. Do I own NVIDIA? Do I not? Do I own tech? Do I not? And I think you want to own tech, and you probably want to own NVIDIA as well. But do you need to own as much as you have now? If you've owned it the last 2 years, you are up a lot. And it makes sense to take a little bit off the table, take a pause. There's a lot of volatility going into earnings tonight, as you've talked about. Many clients I work with are taking some of their gains off, and they're selling puts to monetize that volatility. They'll happily buy it if it falls, and if it doesn't, they still have a core size position, so they benefit if it rallies. Kind of the best of both worlds.
Yeah, I mean, it's probably one of those stocks which it is worth paying up for the puts at the moment. They're probably quite cheap in a relative basis. Bob, let me bring this to you. This is what Goldman Sachs right this morning. Mr. Rubner over there. NVIDIA is the most important stock on the planet Earth. Everyone is in the pool, and they are positioning warning signs. The bar is high, and by high, I mean a big beat is expected. To that extent, this is the poster child of AI. It's added $500 billion in market value this year. Are you filled with fear, or how defining will today be for risk?
Well, the stock is probably the most important thing on stock on the earth today, given the earnings at the end. Look, I own some NVIDIA. I agree, this is not an on-off switch. You can own some NVIDIA. You don't have to be market weight. I'm not market weight, so if it goes up big after the close here, I'll underperform a bit, but I've got some insurance because I own the name. Look, a couple of 3 years ago, no one knew what NVIDIA was. Now it's on everybody's tongue, so it's the stock to watch today for sure.
I mean, there's a certain amount, people talk about emotional intelligence. There's the emotional quotient that we have got to try and disaggregate here. So there's the emotional quotient in looking at NVIDIA and Mag 7, and then there's value. And Bob, by any measure, still NVIDIA on a relative basis, perhaps to some of the other chip names out there, is still below on a forward earnings basis. So there is still justification to be long, isn't there?
No question, the stock is probably priced for an upside surprise. So if they report on target, the stock probably goes down. If they miss, that would not be good news at all. So they've got to beat those expectations, which are already very high, probably higher expectations in it than any of the other chip stocks, many of which I own because they're not as expensive.
And Monica, to you, in terms of how much oxygen this is sucking out of the narrative when you talk to clients, is it?
It is, and in a way, it's a little bit distracting because many clients I work with still don't have enough general risk on. And so they're getting a little caught up in, do I want to own more NVIDIA or not? I'd argue you probably want more risk across the board. You probably need to own more fixed income. You probably need to own more broad equities. I still see way too much cash on the sidelines. And to me, that's a bigger risk than for many people I work with, how much NVIDIA they own.
And this is what I want to get a sense from you, Monica, because I think most people tuning in this morning, they either have their professional day attention in whatever asset class that is, but they've also got their personal decisions to make. Cash, as you say, is the worst performing asset class in 6 out of the past 8 years. Is it getting easier to get them to prize the money out of the cash accounts? And if so, what level of risk are they prepared to take?
I still see a lot of comfort in the yield that money markets and treasuries provide. And I'm sure we'll move to the Fed at some point today after we finish with NVIDIA. But, we know the trajectory. Rates are going to go down. Whether it's in March or June, we know this is coming. And so that is the risk to me of cash. That reinvestment risk is very real. clients I work with haven't faced that in a while. And so it's time to get them reacclimated to owning fixed income. And they don't need to go really aggressive. You can own short duration bond funds. They're going to earn you.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Have to inwardly reflect on. China is grappling market, throwing monetary policy measures at the economy. I caught up with the Rio Tinto CEO a little bit earlier this morning, and he certainly seemed to indicate, perhaps not calling the floor, but to a certain extent, a great deal has passed by in the housing market. You say China has never been as cheap in 15 years relative to the old world index. Is this the floor? Is this the diving off point? Are you brave? Are your clients brave enough to pick up China?
It is so tempting, but people say cheap is cheap, and what stops it from being cheap? And that's the problem. We need that catalyst, whether it comes from more government intervention. You've got to get people comfortable that the real estate woes are permanently behind them in China. I'm not sure they fully are. And there's the question of the regulatory backdrop. And as an outside investor, can I feel comfortable investing in China? I don't think people are there yet either. That said, it screens as the one big dislocated market globally when equities in so many other places have rallied. And so I'm getting a lot of questions on it. People are wanting to add a little bit of risk, but in a smart way. They don't want all the downsides. So we've been looking at things like, can you buy some call spreads? Ways that I can spend a little bit in case it works, but I want my downside to be limited because I'm a little worried about what the government could do at any day.
I've got the sense you've got some pretty sophisticated clients if they're into simple put strategies and actually into a little bit of covered calls as well. I'm going to throw, Bob, this question at you, just see what you make of it. Noel Quinn has got his stress this morning. He's writing down values in France, in China. He's taking hits across the board, but he's paying out more money. But what I do notice is he could go down as the smartest CEO of 2024. He's downsizing his exposure to U.S. commercial property, down by 27% to just under $4 billion. Is there going to be another leg lower of deleveraging in commercial property? Bob, briefly.
My guess is yes. It will take a weaker economy most likely to expose some.
From the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I want it to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think they are important to give more detail, and probably it won't be only on the path of the rates cuts that, by the way, I expect to be displayed mid this year, but having some fresh ideas on the quantitative tightening, because this is what can give some impulse to the curve to steepen.
I was in Monday's Monica Defend with Danny Berger and myself a little bit earlier today, unveiling her rate cut expectations. This as investors count down to the Fed minutes. That's at 2 p.m. Eastern. Hoping it further sheds light on the policymakers' thinking. Mike McKee is with us. He's in D.C. for the day. Mike, how important will these minutes be? We've heard some criticism about Powell and his flip-flopping, so the minutes are perhaps a little bit more exacting?
Well, they will be a little bit more exacting, except that they are 3 weeks old. They will tell us what Powell and company were thinking then. But the problem with these sets of minutes is we did not know at the time what would happen to the economy. We'll probably see in the minutes that they agreed March is too early. Powell said that in the news conference, and they'll restate the idea of 3 cuts in 2024. Maybe conditions for beginning cuts. That could be the important thing today. We get their assessment of the economy and inflation, but remember, on January 31st, they did not know, we did not know that CPI was going to turn around and go up during that month. That came a couple of weeks later, and so the Fed is maybe having to recalibrate. Certainly the markets have, which is the important thing. The minutes sometimes are edited to steer the markets. They don't need to really do that this time because the markets have taken March and pretty much May off the table at this point. Now, do we get something that will point to when they do it? We get a couple more inflation numbers before the March meeting, even PCE inflation, CPI, and then we have the Fed meeting. So we've still got a long way to go here, but probably people are going to look at these minutes and say, we knew what they're telling us.
Yeah, and as you say, a lot of water has passed under the bridge last week, specifically CPI, PPI, and UMich, although a lot of people have been disparaging about the politicization of University of Michigan data. Mike, thank you very much. Mike McKee. We'll bring those minutes to you a little bit later on and parse through the detail. Bob Dole, Monica DiCenzo is with me as my guest. Monica, let me bring it to you. Job done for the Fed. They've brought the market to heel.
Perhaps. I mean, I think the market just wants to see this last bit of it come to fruition. A little more clarity on when the cuts are coming. The market's obviously pricing them in mid-year. I think that makes sense. But I do think that there's still that lingering question for some people out there. Will they actually start to cut by midpoint of this year? So I still think we need to see a little more directionality towards that.
Bob, it's a bifurcation, isn't it, between a Fed panel, presidents, who are scarred in many ways by a number of events in history. 1998, LTCM, long-term credit, go Google. It was a bit of a touchy moment in the hedge fund world, but it was 1998, cuts followed by hikes in 1999, and there were other incendiary devices of policy mistake. Isn't that the issue here, that we have a market which has very little retrospective reference in a bond market and a Fed that is fundamentally frightened of their own shadow of mistakes?
So true. The dialogue is all about, today, tomorrow, the next day, maybe out to June and a possible cut, but the perspective is lost. Most Fed cycles, the Fed tightens until something breaks. Well, other than for a day and a half last April, we had that banking crisis. Nothing's really broken. Is that still a risk? The Fed is twiddling their thumbs, marking time, probably wishing they didn't have to say anything from now until, late second quarter when they come back up for air. So we'll all be watching the statistics. As Mike pointed out accurately, we didn't know anything about the uptick in inflation. We didn't know we'd get a bad retail sales number. Are these flashes in the pan? Are they beginning of new trends? We'll have to watch. And so will the Fed.
So then, I presume you saw Larry Summers' discussion on Wall Street Week where he managed to ignite a 6% possibility of a rate hike. So Bob, I mean, is that a healthy level of concern to have, an outlier risk like that? It's not consensus. It's a 6% probability. It's random walk theory stuff. But is there enough then to justify cutting?
Well, the Fed's certainly unlikely to cut when people are saying maybe rates are going to go higher. It just means there's a lot of uncertainty out there. We still have to see inflation behave itself. Look, the Fed has successfully brought inflation down. I'll use core numbers from round numbers, 6 to 4. That's the easy part. 4 to 2 is much, much harder. So there is more work to do. Have they done enough and just needs to work its way through the system? And I'm sure that's what Larry Summers is looking at and saying, we're not going to get to 2 with what we've done already. So there's a good argument, if you will, on both sides.
And Monica, you are very resolute about the wages component and the tightness in wages, and that is what you think will slow the disinflation progress and therefore mar the cutting cycle.
We believe so, but again, I think we need to see more data. The Fed is telling us they want to see more data before they're willing to say mission accomplished and move forward with cutting. And I think that's the challenge for market participants. Again, you talked about this. People are scarred. They felt like they waited too long to hike, and now they're worried they're going to wait too long to cut. And so there's just this I don't know, frustration in the market is what I feel today, and just a lot of focus on when and timing. And again, I try to tell my clients, just step back. What do you think the trajectory is going to be? Are you positioned for that? And you do want to have some acknowledgement that maybe the market is wrong. And so it's about having some balance in your portfolio to be okay in either scenario.
Okay, thank you very much. Let's see what those minutes deliver, if they deliver clarity at all. And by tomorrow morning, we will be absolutely, we'll have clarity. We'll have NVIDIA, we'll know the future. Bob, thank you very much, Bob Dole and Monica DiCenzo. My guest this morning on the markets. Let me give you your morning calls. We've got Keith Lerner of Truist joining me around the opening bell. Let's see how scared or not, as the case may be, he is of the NVIDIA results.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
We're counting down to the market open, and there is a swing factor at play in NVIDIA. You've got Tesla, you've got NVIDIA, you've got Palantir, all on the downside. But we are nervous ahead of this set of numbers coming through from NVIDIA. And as I say, the market is gearing up for some pretty big violent swings, anything up to 10% either side. NASDAQ down 0.6%, and Breath is down 0.5%. With that in mind, let me get you up to speed with the morning calls on Wall Street. First up, HSBC cuts Home Depot to reduce, saying the outlook for 2024 is challenging as operation costs grow faster than sales. Wendy's is downgraded at JP Morgan to neutral, seeing the stock remaining range-bound. This is you've got competition, capital intensity across the fast food category, and that increases. Finally, Piper Sandler cutting Palo Alto, the networks company, to neutral. The bank joins a chorus of Wall Street downgrades to the network security company. That's after it cut its full-year forecasts. Wow, down 25%. Coming up, Keith Lerner of Truist on the potential fallout from, you got it, NVIDIA's results. This is about a revenue growth of 240%. Never was expectation so high on one individual name to define risk and trajectory on Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
Counting down to a market open that looks a little bit lighter today. Obviously, the big focus is going to be on tech, and there is $200 million worth of options out there. You're going to have a swing on these NVIDIA numbers by 10% is what the options market is gearing up for. So pressure on the equities, it takes you back to 2007. Either you believe that that was a moment that Apple was going to soar and on its way to the next milestone, which is $4 trillion. Is that NVIDIA's story? Is that what you've got to work out? The valuation of NVIDIA relative to AMD, relative to the rest of the stocks in the market, euro-dollar is flat. Now, technically, the euro is up for the 6th day in a row. I know it's hanging on by its fingernails, but you've just sort of got to go with the technicals. 6th day in a row, the euro is up. Yields drop. We're waiting for an auction of slightly longer dated paper, and crude is flat at the moment. 76.99 is where we trade. Look, we've talked about one big tech company, which is NVIDIA, but Palo Alto Networks also cutting its annual revenue forecast, putting the stock on track for roughly the worst day in nearly 7 years. Abby, talk me through the downgrade from the company.
Well, and it's actually gotten worse, the trading action. We're now looking at the worst day ever since this company went public back in 2012. In addition, this is the 4th down day in a row. So that means that this stock traded very poorly into its quarter, similar to NVIDIA. It doesn't mean that NVIDIA is going to put up negative results, but when a stock trades not well into its quarter, it sometimes means that there are folks out there that know things that we don't. What they may have known in the case of Palo Alto Networks is that the guide for the year was not going to be so smart. They took down their revenue guide to a range of $7.95 billion to $8 billion, below the estimate of just about $8.2 billion. They also guided down on billings. They're talking about the idea that businesses are growing, are growing tired of purchasing security. That's always a concern around the IT spend. Will it slow? So they are talking about that a little bit with the cybersecurity spend. What makes that interesting, we of course have had these big hacks in recent years, Clorox, MGM, Industrial and Commercial Bank of China. You were talking about downgrades. Well, we do have at least two. Loop Capital cutting the shares to a hold from a buy, and also Piper Sandler neutral to overweight. The stock, as you know, into today over the last year up more than 100%. Price to perfection, they did not get it. The stock down about 25%.
Yeah, it's brutal whenever it's their own downgrade, which undermines all the bid. Abby, thank you very much. Abigail Doolittle on one of the stocks we're watching. Let's stick with the earnings. We've got shares from Toll Brothers hitting a record high, that after they posted better than expected results. Katie Greifeld is with me. So it's yin and yang, isn't it?
Yin and yang for sure. We're talking about a luxury home builder here. It's really jumping after reporting a strong start to the spring selling season. That helped produce a beat and raise quarter for Toll Brothers. Looking back, Toll Brothers reported that orders jumped 40% from the prior period to more than 2,000. Analysts had been looking for around 1,900 or so. And looking forward, the company said that deliveries would range from 10,000 to 10,500 for the fiscal 2024 year. That's an increase from its previous forecast. Now, to get some commentary here, in addition to, of course, the strong spring expected, the company also said that it's benefited from the improving job market and consumer sentiment, and not to mention an extremely tight inventory of existing homes. That has really been the story of the entire home building sector, and it's why Toll Brothers has more than doubled since the end of 2022, and it's adding to those gains today, of course, up 8% so far, Manus.
Okay, lovely context. Thank you very much, Katie Greifeld. And finally, it's the stock of the day. NVIDIA falling for the fourth consecutive session. Earnings will cross the tape after the closing bell. Alex Webb is with me. Data centers and a great deal of expectation. Alex Webb, good morning. Set the agenda. What's going to be the most important number that we focus on?
As ever, it's going to be the outlook for the quarter that we're in right now. NVIDIA's fiscal year runs through to the end of January, so we're looking at what will happen through to the end of April. The market is looking for $21.9 billion worth of revenue. That's what the consensus is at the moment. It seems as though so far we've not really had any commentary from NVIDIA that suggests that the demand isn't there. The question is really about the supply. Can they get enough of these chips to satisfy the demand? Any indication that there are limitations on that is something that the market will clearly not take very well. The thing is with the valuation, of course, is that, yes, it has driven a lot of the growth across the market over the past year. It's added about $1 trillion in value over the past 12 months. This year alone, it's added 40. This calendar year alone, it's added 40%. It is trading at about 35 times its forward earnings. That is not actually massively more than a lot of its peers. In fact, AMD is trading at 45 times its forward earnings. But the expectations are high. It is guided for this quarter revenue of 20.2 billion. 20.4 billion, my apologies. That is, if it's any less than that, then that is clearly going to be a blow for investors.
Yep, well, it certainly sets lofty expectations. Alex, thank you very much. Alex Webb in London. Let's stick with the NVIDIA theme. Peter Cheer of Academy Securities discussed the impact of the chip makers' results this morning.
I think people are expecting a very, very good beat. And even if they beat, I just wonder who's turning around to buy. It could be one of those cases you get good numbers, it bounces right after the numbers, then everyone looks around, who's the buyer? Turns out no one's a buyer.
Are there any buyers in the market? Keith Lerner can answer that question for us, Truist. Keith, look, we're myopic in this, aren't we? By the way, I think I said earlier the market's set up for $200 million worth of swings in NVIDIA. That's $200 billion worth of swings in the options market. How important is this? I mean, we are so myopic. We are so short-term. Is that going to define the next quarter's risk if NVIDIA can't get a hold of the supply that they need? Or do I need to be a more strategic investor and say, where do I want to be in chips?
Yeah, well, great to be with you, Manus. I think it's the latter. We have to kind of zoom out a little bit because if you look at NVIDIA, at the end of the year, it was trading at 500, and now it's up, even with this pullback, closer to 700. It could pull back $100 and still be in an upward trend. And I think when you think about tech and the broader market more broadly, I mean, it's all about earnings, right? Tech has outperformed over this last year because the earnings momentum has been stronger. So I think what you want to see from NVIDIA is that continue. But I think more broadly, the way we're thinking about things, we were very positive off the October lows. Now we think we're more likely to trade in more of a consolidation, a choppy consolidation, as tech also cools off. I mean, let's not forget, tech was up 30% off the lows from October, and then semiconductors just this year were up over 20%, and we all know NVIDIA before this pullback was up 50. So I think a cooling is more likely, and as long as their earnings are fine, I think as you look out 6 to 12 months, I think that's fine. I think short-term more likely we'll continue to consolidate here.
And you talk about the outperformance in Mag 7. Obviously, Tesla, we can debate whether that drops out of Mag 7 or not. I think that's, an intellectual debate. But you talk about financials being the silent assassin almost in the background, up 26%. What was it? Mag 7 up 26.8%. But there was the silent assassin in financials, up 26.2%. Do you think it's time to delve a little bit deeper and perhaps to ditch those with commercial property exposure? HSBC tanking its commercial property exposure here in the United States this morning.
Yeah, and what you're referring to, Manus, is we did a study and we looked at since the October low, like what was the performance of these different sectors. And what was surprising was that financials were up almost the same as technology, and small caps were still outperforming large caps. So we become myopic just looking at the first 6 weeks of this year, and people kind of lose sight that we had such a big rally at the end of last year. To your point, more specifically on financials, when we talk about financials, we're talking about the broadest sector, and it's much more diverse. In fact, most people may not realize Berkshire Hathaway is the largest holding in the financial sector, but you also have, credit cards, capital markets, insurers. Think about all the prices are going up. That's one way to take advantage of that. And we do like some of the bigger banks in general. I think you have to, as you mentioned, have to be more selective as you go lowest market cap, and especially be aware of the commercial exposure.
Well, you got to hand it to Warren Buffett. I mean, who's the cleverest of them all on his call on Japan? I mean, he was just way, way, way ahead of the posse, wasn't he, this time last year, if you remember, into the brokerages. That's a whole other conversation. Where are you on the consumer? We just had Katie run through Toll Brothers. I mean, that's a very clear supply constraint story, but it does tell me something, again, perhaps about bifurcation, that awful overused word, in consumer markets. Toll Brothers, relative to what's going on at Walmart. We're getting choosier at Walmart, choicier decisions, versus Toll Brothers, which just extends and extends.
I think you're right. I mean, I've used the word bifurcation as well, so maybe I've overused it.
It's not personal, by the way. I've overused it and abused it myself, so it's not just you.
Yeah, but it is, when you think about the economy, it's, what economy, what consumer. The high-end consumer right now is doing pretty well, right? We have asset prices close to all-time highs. We have real estate prices going up. A lot of folks either don't have a mortgage or they're locked in at 3%. I will say even more broadly, though, I know there's the excess savings. We can debate what that actually is. But one positive, even with this uptick in inflation that we've seen, is that wage growth, for really the first time during this post-pandemic period, is now above inflation. So in our view, that should continue to support consumer spending at a steady pace. Now, we are expecting a step down from what we've seen the last couple of years, but in general, I think that's a positive. The other thing that's kind of a wild card out there, which could be a positive, there's these tax proposals out there as well, which could also benefit. We are in an election year, as you know.
We are, and we're also in a hot war year as well. I mean, I've had one or two people come on and say, listen, either way, either throughout this year and going into next year, regardless of who is in the White House, by the way, defense, cybersecurity, those deep expenditure areas that are unavoidable need to be re-examined and need to be upped in scale in the portfolio.
Yeah, I think it's notable that technology is the one sector that made an all-time high, but the other sector that made an all-time high recently was industrials. And it's a very diverse sector, but to your point, defense spending is not going lower, it's going higher. And it's not just in the U.S., it's global spending is likely to go higher as well. So I think that's a secular tailwind that's going to be here for many, many years. So again, I think that's a positive attribute. We're also seeing this manufacturing renaissance. You see it in the construction numbers just going V-shaped. And what's also probably missed somewhat is a lot of the different acronyms that we talked about, fiscal stimulus the last few years, the IRA, the infrastructure bill. A lot of that spending is just starting to hit this year and to next year. So that will be a tailwind in our view for several more years.
Well, we saw that come through in Intel and Global Foundries yesterday, Keith, in terms of the potential lending to them. Keith, thank you very much for being with us. It is Keith Lerner there, my guest on the markets, coming up. A miss for HSBC despite record profits.
Our confidence is there in the reiteration of our 2024 target to deliver mid-teens returns. We've reiterated that target today.
We'll break down the numbers next on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Our confidence is there in the reiteration of our 2024 target to deliver mid-teens returns. We've reiterated that target today. That gives you a measure of confidence, and it will give you a measure of our ability to continue to distribute to our shareholders. You know, if you look at all of what we distributed on 2023, that's around about $19 billion of capital return to our shareholders.
And another $2 billion buyback today. Noel Quinn speaking to the team a little bit earlier. That's after the company reported fourth quarter profit that fell 80% after taking unexpected charges on their holdings on a Chinese bank. This comes in as we've got rising interest rates boosting HSBC's full-year earnings to a record, with the bank's bonus pool hitting a decade high. Quinn's pay himself almost doubled. And that's, I suppose, at the same time, we saw Citi, the CEO there, Jane Fraser, also got a big pay bump for last year, up 6% to $26 million. Tom Metcalf is with me. So Noel was in fighting form, which is jam for the shareholders, which is a buyback, and a reality check on China. But he does say, look, I wasn't forced to take these write-downs on China. It was not due to conversations with external parties. He's cutting commercial property. He's taking write-downs. He's kitchen sinking.
Yeah, I think that's a good analysis. I mean, it's pain today, and then the hope is they have a very clean sort of slate going forward. And they're very clear, or he was very clear on this messaging about China. They do not see this as sort of, a reason to be cautious. They, in fact, see a lot of growth there. Obviously, shareholders taking a different view, shares down more than 5% still. Definitely a surprise, and maybe that's the biggest problem here, is it just wasn't expected. And, no one likes a surprise like this comes very early on a Wednesday morning, right? It drops Asia time. And then you're suddenly like, oh, there's a $3 billion charge we weren't necessarily expecting. So perhaps no surprise the shares have fallen today. I'll sort of take the longer view and wonder if sort of, they'll rebound a bit tomorrow.
Now, since Noel's not with me, I can be cheeky and ask you the question. He's had a pay rise from the board, obviously. Does he deserve it?
well, it's quite the pay rise, right? It's almost doubled. So, you know, and I think that's maybe the disconnect you get when you have that big impairment like today. It just seems like a strange time to go through that. But I think what it really shows is, look, HSBC as a company, extremely sort of comfortable where they're at. They think underlying business is strong, and obviously they're rewarding their CEO for that. So that was a bit of an eyebrow raiser, just because you don't often see someone who's paid double. But again, bit of context, I think it's risen to about, you know, $15 million or so. You know, you compare that to a Jane Fraser, you compare that to a big Wall Street bank exec, and you know, Mel Quinn is getting relatively underpaid somehow.
He'd probably be glad to hear that. Just a very, very quick chart for HSBC from September 2020 through to today. The stock is up 94%. I mean, not at the zenith that it was before, but it has had a nice updraft. Okay, Tom, thank you very much. Tom Metcalf. Next time I see Noel, I suppose he'll take a swipe. Let's talk about geopolitics. Politics here in the United States of America, of course, is expected to announce a fresh round of sanctions against Russia this Friday. Now, the proposed curbs are designed to hold Russia responsible for the death of the opposition leader, Alexei Navalny. Amri Hordan joins me now to discuss this. Amri, again, I'm quite surprised about the huge flagging, early warning that this administration is giving for the upcoming sanctions. What do you think we can expect?
Well, they've been getting a lot of questions on when they were going to potentially move in terms of penalties because of Navalny's death. In 2021, President Biden was asked about a circumstance like this. What would happen if Navalny was to die? He said there would be, quote, devastating consequences. The issue was, in 2021, they had a lot more tools in the toolbox. They've used a lot of those potential sanctions and penalties they could put on Russia with Putin's invasion of Ukraine, which is why people think potentially it's going to be in the metal market. In December in the United Kingdom, they barred a number of individuals for trading some of these hard metals. And in the UK at the time said, there's potentially more we can do when we work with international partners. So potentially this is going to be what the penalty is.
Okay, and Nikki Haley, absolutely defined. I mean, this lady, despite what happens in South Carolina, she's sticking in there.
She says she's going to go. I think she hoped for a better showing. Well, let's see what Saturday brings. But, you know, she hopes for a showing in her home state. They twice elected her governor. The poll this morning that stuck out to me, Suffolk University, USA Today, 2-1. 63% Trump, 35% Nikki Haley. So it is a steep climb for her. And the director there saying the issue with the poll and the story of this poll is the depth of strength Trump has. But she remains, as you say, Manus, defiant. She's going to continue after the South Carolina primary.
Okay, and now he's got a new sneakers line to go as well. So there you go. All to play for in U.S. politics. Amri Hordan there on the political situation and the race in South Carolina. Sector price action. Abby is with me. Abby, what have you got?
Well, it's interesting. We have more sectors that are higher than lower, but we do have the S&P 500 heading to a third down day in a row. So this has everything to do with the fact that the worst sector on the day, tech, down 1.3%. That's a big, big weighting to the index. And of course, the SOX, the chip index, the chip stocks, I should say, a big piece of that downfall today on the day. Fears going into that NVIDIA quarter. We have communication services, another heavyweight sector, down 0.7%. On the other hand, you have a number of sectors that are actually up 1% or thereabouts. Energy, utilities, consumer discretionary. Let's take a look at one sector this week that's really slipped through the cracks to some degree. We actually talked about it on the Stock of the Hour yesterday, but the S&P 500 food and beverage and tobacco index, it's really outperforming so far, up 1.81%. This is, we have the 2024 CAGNY conference, and Kraft Heinz really talked about how they're going to invest in their technology. And not surprisingly, Manus, we did have talk about the weight loss drugs. Conagra saying yesterday that they, or this week, that they see positive trends against those weight loss drugs, that they are seeing volume increase in single-serve meals for those people trying to lose weight. So that stock is another reason why we have this index higher so far this week.
Abby, thank you very much. Great work through the morning. Coming up in the show, market moving events for your day. It'll come down to those Fed minutes and NVIDIA, but we'll just block it away for you in a moment.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
The stakes are high today. The definition of risk will be what will NVIDIA deliver. The NASDAQ is down by 0.8%. The market is positioned for $200 billion worth of variance. Puts and calls have traded. That is the scale of the volatility that NVIDIA could deliver today. As we discuss what the Fed minutes will be, we may get a little bit more acuity on what is it that's going to confirm for the Fed that they can begin to cut rates. And the risk is, of course, from Larry Summers flying the kite, that maybe even one of those potential outliers could be a rate hike. So we are nervous, and the oxygen is thin in stockland. NVIDIA will define just exactly how rare that error will be. Here's your trading diary. I mentioned a couple of things for you. We'll get the Fed minutes at 2 p.m. Eastern Time. Mike McKee's hunkering down in Washington. We'll bring those to you live. NVIDIA reports after the closing bell. We'll take a look at the revenue growth along with the data centers, the trajectory, and the supply. The supply is critical for the growth story within NVIDIA. US PMIs and another round of jobless claims hit the tape on Thursday. That takes you to Friday with Fed Speak. Post these minutes, it's going to be the freshest intonation from Jefferson, Bowman, Harker, Cook, Kashkari, and Waller. So that's quite a digestion. Taking you through to Friday, you've got Warner Brothers and Discovery reporting their earnings. Let's stay to play on the market. You've had Tesla manage to turn it around from a pre-market tank. We're up at 198.06. We'll leave it with you. NVIDIA will define perhaps the next leg of risk on the NASDAQ, as it has put on nearly $500 million in market cap since the start of the year. That was Countdown to the Open. This is Bloomberg.
politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you head over to youtube.com, search Bloomberg Radio, Bloomberg Podcast. It's all there. You can find it there. Bailey Lipschultz sitting in for Alex Steele. Alex Steele is out this week. She'll be back on Monday. Lots to go over today. We're going to check in with Ira Jersey, get his call on where he thinks this Fed is going. And we're also going to check in with Craig Trudell. He covers the auto industry. He's the czar. Get a sense of what's happening in that EV business. Kavita Gupta is also going to join us. She's a founder and managing partner at Delta Blockchain Fund. Joins us to discuss the latest on Bitcoin and all things crypto. Maybe Matt Miller will dial in here. We'll see about that. But first, let's kind of kick this thing off here with Lisa Mateo, get a sense of what's happening out there with the world.
You got it. Market Drivers brought to you by Interactive Brokers, IBKR's redesigned Fundamentals Explorer. It provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit IBKR.com. Well, could Wall Street be in store for a third day of declines? Well, it kind of seems to be looking that way. NASDAQ is leading the losses, down about 0.6% right now. NVIDIA earnings has a lot to do with it. Wall Street set these high expectations, but investors, they're a little bit cautious. Right now, shares of NVIDIA, they're down about 2%. Later this afternoon, we get minutes from the Fed's last meeting. Now, as far as yields, they're lower. The 2-year yield at 4.59%, the 10-year at 4.26%. And commodities, COMEX gold is lower at $2,038 an ounce, spot gold at $2,027 an ounce, NYMEX crude $77 a barrel, Brent crude at $82 a barrel. That is your Bloomberg Business Flash. Paul and Bailey.
All right, Lisa Mateo, thank you so much. We appreciate that. Bailey Lipschultz, Paul Sweeney live here with you in your Bloomberg Interactive Brokers studio. Bailey, I guess it's NVIDIA. That's kind of the story of the day. You know, this is a stock that it's not just a bellwether for like the tech sector. It feels like it's become a bellwether for the market. And you think about the November, December move we had last year, and a lot of it was just kind of tech-driven.
Everything's tech-driven. Everything's around that AI mania. Yep. Can NVIDIA live up to the hype? It really, I think Goldman Sachs this morning said it's the most important stock ever.
Yeah, exactly. On the planet.
On the planet. So when Goldman starts saying that, maybe a little bit scary going.
I mean, I guess I would think the options trading around this, over the last few days, it's just been fast and furious. People trying to, lay some bets because you just know that there's going to be some big movement one way or the other.
Well, that's the interesting thing. You look at the implied move on the terminal. You go ERN function, 11% move. Priced in is what the options are showing, either to the up or downside. But the interesting thing is the last 2 quarters, last quarter you had a drop of 2.5%, quarter before that flat on the day. Then you go back to when it really blew kind of the roof off of earnings, 24% surge, 14% surge. Not really things that you would expect.
And by the way, for our terminal users out there, ERN, that's a good one. I forgot about that function.
Yeah.
That is really cool. So again, the takeaway, the implied one-day move is almost 11%. That's a lot, on earnings day.
Especially for a $1.7 trillion company. I think we were talking about it on one of our calls this morning, and it would likely be, in terms of market value, if that played out, the largest one-day swing in terms of market value added.
Yep, good stuff. All right, we'll stay on top of that. We, that'll be after the close today. Norma Linda joins us. She covers the entire equity market for Bloomberg News, and she joins us here in our New York City studio. Norma, what are you looking at today?
Let's kick things off with Toll Brothers. Yep. Looking at some home builders here.
You like the home builders because you cover
that's my space. I'm biased. Okay. That's all you're going to hear from me.
I tell you, they have been great stocks, boy. They've been ripping.
They have been ripping. Let's look at Toll Brothers. That is a luxury home builder. So if you're into the bougie stuff, this is for you. Those shares are jumping as much as 7.8% for their highest intraday level on record. Now, this company really saw a massive EPS beat, gross margin beat, and these are the metrics that we're really looking at when we think about real estate and home builders. And not only that, but it boosted home sales gross margin when we're looking at the future. And the interesting thing about Toll Brothers is, as we think about home builders, they've really been offering a lot of incentives, specifically as it pertains to rate buy downs. Now, Toll Brothers, in terms of the last quarter, that's not necessarily what they relied on. It actually saw its base prices rise about $12K per home, and its incentives fell about $4K per home. But as we're looking at this quarter and these results, the company said that few buyers are choosing mortgage rate buy downs and are now leaning toward other incentives. I found that interesting.
Yeah, I do too, particularly since we have the mortgage rates back up over 7% now.
So it sounds like people actually have the cash. I mean, we are in a luxury space.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups, is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Son in technology, but he's doing rockets and stuff like that. But cybersecurity, it's never going away. I mean, you have to spend every year on it, I would think, if you're any kind of company.
Yeah, and especially with the amount of hacks that we've seen. What was it, Clorox at the end of last year, basically having their business put on a standstill. So you're seeing the kind of rise of these hacks. I would assume that you're more than happy to have companies come out and spending, but very cautious commentary from Palo Alto Networks.
Exactly. I want to quickly move to CoStar. That's ticker CSGB, GP. Those shares are rising as much as 3.4% this morning. That's an information services company that provides commercial real estate research, back in my real estate bag. It reported fourth quarter results and gave an outlook. And some firms did see the profit outlook as weak, but are recommending that investors buy the dip. So we are seeing those shares up, as I said, a little bit more than 3% this morning. So it does seem as though some people are out there. We had Stevens, actually, the company moved CoStar to its 2024 best idea list, once again citing that buying the dip and seeing this as a clear buying opportunity.
All right, very good. I mean, Palo Alto Networks, I know nothing about the stock, but again, it's one of those things where if I were a PM, I'd get my tech analyst in here and say, should we be buying this thing here? It's just one of those things when you see something in an industry you love, and you see, all right, they blew numbers, they're going to get taken out to the woodshed, I get it. But is there any reason to believe that they're not going to benefit from these long-term trends that we believe in?
No, definitely. You're looking right now, the stock up past 12 months, 62%. Coming into the print, 119%.
Okay.
So high expectations, high bar, but as you're saying, which I kind of agree with.
Yeah, I mean, I've been just steamrolled a million times with that kind of strategy in the past. Like, oh, let me see if I can catch this falling knife. Yeah. Hasn't worked out. Norma Linda, thank you so much. We appreciate that. Norma Linda, she covers all the markets for us. We appreciate getting a few minutes of her time. Let's check in with Ira Jersey here, because I want to know what my Federal Reserve is going to do. I mean, I've got, the Fed watchers, they were pounding their chest. March, we're going to get a, rate cut. 6 rate cuts in a year. Yeah, and now it's kind of May. Now people are talking about June. And we've had a couple of smart people come in here over the last couple of days and say, hey, you better have a scenario where they raise rates. So I have no idea what's going on. So let's bring in Ira Jersey, because it's his job. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Ira, it seems like this thing changes day by day, and I guess that's why the good folks at Bloomberg made the WERP function, because it just changes all the time. It's a fluid situation. Given kind of what we know here in the economics and some of the data we've seen, how do you think the Fed's feeling today?
Yeah, so we're get a lot of Fed speak this week. We have the minutes at 2:00 today, so we'll see what they were talking about in some more detail than we got during the press conference from the January meeting. But my view has always been that we were probably going to only get a few cuts this year. So we thought 3 cuts going into the year over the course, and part of the reason for that was we thought that it would be pretty slow going in getting inflation back toward the Fed's target. And so far that's played out more or less the way that we thought. So we'd been figuring that they would cut one time before middle of the year, in part to kind of get that first cut over with before the election, and that gives them some flexibility depending on how the numbers come in. That being said, as you noted, Paul, one of the factors that we highlighted last week was that people are buying options on the potential for higher rates. So there are some people who are getting a little bit concerned that there might be this tail event where maybe the Fed is on hold most of the year, but sometime in say the fourth quarter, maybe just after the election or something, they have to hike because inflation and the economy is holding up reasonably well. So even though that's not a base case of just about anybody that we talk to, although there are a few outliers there that certainly think that that's a possibility. I think that an on hold case is much more likely, and you've heard some people in the fixed income markets talking about that as being more and more realistic possibility that the Fed just doesn't cut for a long time or doesn't move at all.
Yeah, Ira, with that notion, hold higher for longer has been something Jay Powell said for quite some time. You're talking about a cut coming later in the year. Are we talking September, November timeframe?
So September, I think, will be a little bit hard, even though the Federal Reserve says that they're apolitical. But I think that they wouldn't want to start any new actions just prior to the election. And September is that meeting that sits in between the conventions and the general election. So I think that they wouldn't start anything then, which is again another reason why thinking that maybe they would do a move in say May, June, or July just to have it out of the way, and that gives them flexibility to continue those actions. It's definitely possible, just given the strength in the data, that maybe the Fed doesn't move or doesn't have to move until after the election. That's there's a non-zero chance of that, and I think that if we continue to.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
What we're not talking about, but it's also a balance sheet runoff, right? So it's completely possible that even if the Federal Reserve doesn't cut interest rates at all this year and keeps rates relatively high, it is possible that the Fed is going to have to reduce the amount that it's running off its balance sheet. So there's so-called quantitative tightening, and as that happens, I think the market will take that as somewhat of a dovish bent to the Fed and the Fed activities. So you'll probably see things like risk assets do pretty well, right? Credit spreads tighter, equities do okay. The rate market will probably rally just a little bit on that, just as they'll take it as a dovish signal. I don't think it is, because I think that the balance sheet policy at this point is going to be somewhat disconnected from rate policy, because balance sheet policy has other implications in the banking sector, and how much bank reserves do people need in order to comply with some of the capital regulations and the like. So that's going to be completely different. But that is something in the minutes that I'm really looking forward to seeing what they talked about and how they're going to frame the discussion that they're going to have in March, because Jay Powell did say that in March they're going to start their talk about balance sheet policy.
All right, so I get home my new hours. I get home in the afternoon. I turn on CBS. I see Inter Milan playing Atletico Madrid.
Yeah.
I think that's what I was seeing. Good match. I don't know why I was on the CBS network in the middle of the afternoon. That's another question. But Ira, what was I watching yesterday?
So the Champions League,
I guess.
So the best teams in Europe all play each other, or the teams that won their leagues or came in the top a couple of spots in their leagues. So Atletico Madrid would be playing Milan in the Champions League. The reason it's middle of the day is because it's evening in Europe.
But my question was, why was it on CBS network? I'm not watching some silly soap operas or game shows or something like that. So that's for me. That's a media question. I'll call my friends.
Yeah, CBS has the rights to the Champions League, just like NBC has the rights to the Premier League and the like. So you're going to see it on whatever network bought those rights in the U.S.
So, who is favored in the Champions League? Is that it?
Yeah, I think it has to be last year's champions, Manchester City, right? They're still one of the creme de la cremes, but the Milan teams and Bayern Munich and PSG, like those teams can never be ruled out for sure.
I'm an Inter fan, so
you're
you were watching my team play.
It was at San Siro.
Yeah.
I've been to the San Siro.
Oh, really?
Yeah, some AC Milan played there back in the day. So
that's awesome.
Yeah, it was pretty cool. They are insane over there, the stuff that they do. I mean, they light stuff on fire, fireworks. I mean, it's just crazy. All right, very good. Ira Jersey, thanks so much. As always, Ira Jersey, he's our chief U.S. interest rate strategist. He's also our go-to soccer aficionado. How did you become an Inter Milan fan?
They were a really fun team when I was in high school. They actually won the Champions League right after I became a fan, which is hard to let go of a team that's good.
Sure.
So I kind of stuck to it. Also, everyone's a fan of English soccer.
Yes.
It's kind of too mainstream. So Serie A, Italian soccer really spoke to me, I guess. So
there was a time when that was a top league, and it's still a top league, but it's really fallen behind the Premier League, right?
Spending in the Premier League is just paramount to their strength. Yeah,
right. That's where the money is. Yeah. So, all right, we'll see what happens when I get home today and turn on the TV. I mean, can I watch a baseball game? No, they have soccer on the CBS television network. Go figure. I've figured that out. All right, S&P 500 off 0.1%. We'll have more coming up. This is Bloomberg. Good morning.
hits, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Red on the screen this morning. This is ahead of the release of the Fed's minutes from its last meeting and ahead of NVIDIA results that will be released after the close. Taking a peek at NVIDIA right now, it's down more than 1.5%.